So before starting derivative analysis and valuation, so let me come from the beginning. Okay, what are the mistakes committed by students? Basic conceptual mistakes. The reason, lack of conceptual clarity. If you lack conceptual clarity, then what? Either you should enroll for regular classes or at least exam oriented class, worst case scenario. Okay, so clerical errors. So reason, lack of a practice, and for lack of a practice, solution, attend OG revision series, and if possible subscribe to BCCA test series. Okay, write examinations, at least 2 grand tests, then you can learn time management. Okay, and next, oath. Pramada, what is oath? I'm not going to use mobile or phone or a social media till December. Schedule. Now we are in day 2. So what is our topic today? Derivatives. So what is the duration of a class? Until we complete derivatives. Okay, so today we might complete our class by 4 o'clock. If you practice questions fast, that depends on you. Okay, but if you are doing questions slowly, then class may extend up to what, 10 o'clock. That depends on you. Okay, so today the class timings, class starts with what? Now class starts with at 2 o'clock and ends whenever we complete derivatives. Third day topic, security valuation and evaluation of risky proposal. Day 4, mutual funds, super 50 questions from investment decisions and leasing. Day 5, forex super 50. So that's why ask me starting time of a class, ending time even I don't know. So that's why please do not ask me. I'm dedicating this revision series to all working or married men and women who are preparing for CA or a CMA, and also my Coal India friends and my guru RK Sahai sir, ex-director of finance of Bharat Coking Coal Limited, subsidiary of a Coal India Limited. Okay, so this is dedication note and gratitude. If you like this class, please like, share, comment, subscribe, and click on the bell icon. Okay, and also please do attend a felicitation program with parents, which is being held at BCCA main branch, Nujvedu, Andhra Pradesh, in the month of February. Okay, and also refer our regular classes to your juniors. Now comes the main part, sources considered. Because the frequently asked question, sir, is this BCCA material enough? Is this revision series enough? Okay, yes, this revision series is enough. Because the reason is I have considered CA final study material, CMA final study material, CA final past papers, CMA final past papers, and also CMA workbook. It doesn't mean every question which is in CMA final study material is included in revision series or BCCA material. Whichever is relevant, okay, from examination point of view, those questions are included in material. Okay, and for updates and materials or doubts clarification, please join our telegram groups. We have created telegram groups for each subject separately, except for DT and IDT, and also about SCM and SPM. Okay, so telegram group links were provided in the description. So thank you all. Without wasting time, let us start derivative analysis. You know that derivative analysis is a category topic. Why? Because derivatives you will get 2 7 marks question and 3 multiple choice question. So today morning I have received one message. Okay, that message is, sir, yesterday class portfolio management was very nice. Today derivatives, please explain options and futures, because last time from super 50 questions were not asked from in derivatives. First sentence, okay, fine, yesterday class was nice. Second sentence is what? So in June 2025, so derivative questions are not from super 50 list. Okay, I will tell you the numbers. BCCA material, main question number 7 and the main question number 10. These 2 questions are asked in June 2025, and these 2 questions I have given in super 50 also. Super 50 also. You can go through my marathon, which was recorded 1.5 years back. In that marathon also, I have discussed the 2 questions. Okay. One thing I want to make you clear. So, Super 50 important questions, bullet MCQs or bullet 50, something. I'm giving you different names, but for every attempt, I will give a same set of questions. So hardly there will be a 5% variation. 5%. For example, in 50 questions, hardly 5 questions may change, but remaining all questions will remain same. And how I am picking the questions? I will be picking questions, advanced questions. First of all, I will arrange all the questions in ascending order, easy to hard, easy to hard. And in every concept, I will be picking an advanced question. And in exam also, they are asking advanced questions. In exam also. So that's why questions are appearing from Super 50. Okay. And if you listen to this revision series, then you will get to know whether Super 50 questions appeared in examination or not. Okay. So derivatives is a category topic. It is a simple topic. Derivatives. See the overview. Derivatives. Okay. Wali, please share this PDF in group, Telegram group. Concept book. Solutions. Okay. So derivatives. So derivatives is a simple topic. The weightage of this topic 7 marks. 6A and 6B. 6A and 6B. And you will get 3 multiple choice questions. So derivatives. So we have 3 types of derivatives: forward contract, future contract, and options. In this chapter, we are going to discuss futures and options. Futures and options. In futures, we have 3 concepts: margin account, fair future price, and arbitrage, hedging. So hedging is the most important concept. Hedging is a frequently asked question. In futures, hedging is very important concept. So in last June 2025 also, descriptive question was asked from hedging concept. Margin account, fair future price, and arbitrage, hedging. Okay. And in options, we have 2 categories of questions: basic questions and option valuation. So in June 2025, basic question was asked. BCCA material, main question number 10. Okay. And options valuation. Option valuation, we have 4 option valuation models: risk neutralization, binomial, 2-period binomial, Black-Scholes model. Black-Scholes model, last time it was asked in the year 2013. In the year 2013. Okay. So frequently asked models are risk neutralization and binomial model. Binomial model. Okay. So clear. So total how many parts we have? 2 parts, futures and options. And in futures we have 3 categories: margin account, fair future price, and arbitrage, hedging. Options we have a basic question and option valuation. Okay. In margin account we have 3 types of margin: initial margin, maintenance margin, and variation margin. So hedging we have 3 types: cross hedging, taking an opposite position in index, buying risk free security, selling high risk shares, and buying low risk shares. Okay. I have arranged all the questions systematically for hedging concept. You need not worry. Now, derivative analysis. What is the meaning of a derivative? What is the meaning of a derivative? So derivative means an instrument, the value of which is derived from the value of an underlying asset. So first of all, you should know the meaning of derivatives. Derivative means an instrument, the value of which is derived from the value of an underlying asset. Derivative value depends upon the value of an underlying asset. So first you should understand the meaning of this derivative. This is very important. So basics are very important for especially option valuation. Okay. So, but in portfolio, every concept is important. But here, if you learn basics, then you will find every question easy. So derivative means an instrument, the value of which is derived from the value of an underlying asset. So underlying asset can be a share, commodity, interest rates, or a currency. Okay. So underlying asset. Derivative examples: futures, forwards, options. Forward, futures, and options. So for example, call option. Call option means right to buy a share, commodity or a currency. Okay. For example, we have taken a call option of a X limited share. X limited shares. 3 months call option of a X limited share was purchased. 3 months call option of a X limited share. Strike price is 300. Strike price is 300. So what is the meaning of this sentence? The person who is purchasing a call option will have a right to buy one share at the rate of 300 on the maturity, on the due date, on the due date. Okay. So for suppose on the maturity, if the share price increases to 400, the person who has purchased the call option will have a right to buy share at the rate of 300. If a share price increases to 400, then what? The buyer of option will exercise the call option and will buy one share at the rate of 300, which is worth of 400. So that means the call option value is 100 rupees. Call option, okay, value is what? 100 rupees. So derivative, call option is a derivative, the value of which is derived from the value of an underlying asset. In our example, what is an underlying asset? X limited share is an underlying asset. X limited share is an underlying asset. Am I clear? So without wasting time, what is forward contract, futures contract and options? Forward contract is an obligation, but in forward contracts we have a risk of a default. Why we have a risk of a default? Because we know the counterparty, two parties will enter into a contract. The counterparty may make a default, and so there is a risk of a default in forward contract. Futures contract is also an obligation. The main difference between the forward contract and futures contract is, in futures contract there is no risk of a default, because the reason is futures are traded on stock exchange. Okay, initial margin is collected from the parties to the agreement. Initial margin is collected from the parties to the agreement. Initial margin is similar to a security deposit. Security deposit from both the parties. In contract, there will be two parties involved, yes or no? One party will sell and one party will buy. From both the parties, initial margin will be collected. So like a security deposit, as there is a security deposit, there is no risk of a default in futures contract. And these futures are standardized. Futures are traded on exchange. Forward contract is not traded on exchange. Option is a right. Option is a right. It is not an obligation. For example, call option, right to buy at the rate of 300. But whereas if on the maturity, share price is equal to 200 rupees and I have a right to buy at 300, am I going to exercise the right to buy at 300? No, because in the market the price is 200 rupees. I am not going to exercise the right. So option is a right. Option is a right. And in case of option also there is no risk of a default, because the reason is the person who is purchasing an option will pay premium to the seller of an option. Buyer of option is called as holder. Seller of option is called as a writer. Okay. And three parties are involved in the market. Generally, you will find three parties: hedger, speculator, arbitrator. Okay. Arbitrator spelling is wrong. Ignore it. Hedger, speculator, arbitrator. Hedger objective is to reduce risk. Hedger objective is always to reduce risk. Hedging means mitigation of a risk. Hedging means mitigation of a risk. Mitigation of a risk. Hedger objective is to reduce the risk. Speculator objective is to earn profit by taking a risk. By taking risk means uncertainty. There is a possibility of occurrence of a loss. So speculator may get a profit or a loss. Arbitrator will identify market imperfection and he will earn profit. He will always earn a profit without taking any risk. Arbitrator will be identifying the market imperfection. We are going to do questions on hedging as well as arbitrage process. Arbitrage means what? Arbitrator will identify the market imperfection and he will be making the profit without taking any risk. He will not use his own money. He will be always borrowing the money. So what can be the underlying asset? Currency, commodity, stocks or bonds can be an underlying asset. Now comes the futures contract. First part, futures contract. We have three categories of questions: margin account, fair future price and arbitrage, hedging. Margin account. So we have a three types of a margin: initial margin, maintenance margin, variation margin. Initial margin mu plus 3 standard deviation, 3 times of a standard deviation. Mu means daily absolute change, daily absolute change. So right now the initial margin, okay, how much percentage initial margin, mu daily absolute change plus 3 times of a standard deviation. Nothing but if risk of a security is high, then initial margin collected from the investors will also be high. So higher amount of security deposit is collected for the high risk securities. Simple logic. So what is the initial margin formula? Mu plus 3 times of a standard deviation. Sometimes they will give directly a percentage. Initial margin is equal to 10% of the contract value. Since CFL one past question, they have given an initial margin directly 10% of a contract value. Then you need not apply this formula. Mu plus 3 times of a standard deviation. Maintenance margin, this is a minimum balance to be maintained. Minimum balance to be maintained in the margin account. So first of all, this initial margin is deposited in margin account. Initial margin is deposited in margin account. Maintenance margin. Maintenance margin means minimum balance to be maintained in the margin account at all the times. Whenever the balance in the margin account falls below the maintenance margin, we should bring back the balance to initial margin. We should bring back the balance to the initial margin. The amount deposited is called as a variation margin. Variation margin. Okay. So initial margin, maintenance margin, and variation margin. So what is this margin account? If an investor is entering into a futures contract, okay, every person, whether a person is purchasing or selling, he has to open a margin account. He has to deposit initial margin. In futures, we have two positions: long position, short position. Long position means a buy position. Short position means sell position. A person who has an expectation that the price is going to increase will take a long position, and a person who has an expectation that the price is going to decrease will take a short position. So for suppose I am taking a long position and you are taking a short position, we both have to open a margin account. We have to deposit what? Initial margin. So initial margin is security deposit. You have to deposit security deposit. I also deposit the security amount. And in this margin account, for suppose you have taken a long position, I have taken a long position for 3 months, X limited share. That means, what is the meaning of this? I am entering into contract to purchase share of X limited at the end of 3 months. You have taken a short position. If you have taken a short position, what is the meaning of this? You are entering into contract to sell X limited shares at the end of 3 months. Okay, we both has to deposit what? Initial margin. We both. Okay, and settlement will be done at the end of 3 months, no doubt. But here the profit and loss is calculated on daily basis. On daily basis, profit or loss is calculated. Okay, and margin account balance will keeps on changing. For example, next day we entered into a contract as on today. Next day the price has got increased. Then what happens? The person who has taken a long position, his balance will increase, and the person who has taken a short position, his balance will decrease. Okay, so initial margin will decrease. So whenever the initial margin falls below the balance in margin account falls below the maintenance margin, you will get a margin call and you have to bring back the balance to the initial margin. So the amount deposited is called as a variation margin. So we have a question to understand this concept. Question number 1. See the question number 1, margin account. So this is a referral question, A plus category question. Only one question for margin account. One question is enough. If time permits, then go for what CA final past question, margin account. I will share that question in Telegram group. You need not worry. So question number 1. So see how the futures works. Sensex futures are traded at a multiple of 50. Consider the following quotations of Sensex futures in the 10 trading days during the February 2009. Day, high, low, closing. 4th February, 5th February, up to 18th February. Abhishek bought one futures contract. Abhishek bought one Sensex futures contract. Abhishek bought one Sensex futures contract means what? Bought means he took a long position. He took a long position. So that means he will get benefit if a price increases. And underlying asset can be what? Index. Index can also be what? Underlying asset. Here Sensex is an underlying asset. Sensex is an underlying asset. Okay. And you know that today if we are taking a long position to settle the contract on the maturity, we take a short position. If you are taking a short position as on today on the maturity to close the contract, we take a long position. Okay. So Abhishek bought one Sensex futures contract on February 4. The average daily absolute change in the value of contract is rupees 10,000. Standard deviation of these changes is rupees 2,000. The maintenance margin is 75% of initial margin. You are required to determine the daily balances in the margin account and a payment on margin calls if any. You are required to determine the daily balances in the margin account and payment on margin calls if any. You are required to determine the daily balances. So let us see how the margin account works. Simple. First we should find out the initial margin. Sometimes they might give directly 10% of contract value. Okay. So daily absolute change plus 3 times of a standard deviation. So this is the custom. Okay. The logic is if high amount of a deposit is collected for what? High risk securities. High risk securities. If a daily absolute change increases and the standard deviation increases, then obviously what happens? Initial margin will also increase. What is initial margin? 10,000 plus 3 into 2,000, 16,000. Maintenance margin 75% of 12,000. So margin account of Abhishek. So margin account of Abhishek. So he has taken a long position on February 4th. February 4th. On February 4th, what is the closing price? 3296.5. Okay. So on 4th February, he has to deposit what? 16,000. On the other side, the opposite party will also be depositing the same amount, 16,000. But Abhishek will not be knowing the counterparty because futures are traded on stock exchange. We don't know with whom we are entering into a contract. Okay, so the counterparty will also be depositing the same 16,000. What happened on 5th February? On 5th February, the closing price is 3294.4. So what happened? The price increased or decreased? The price has got decreased. Price decreased means we took a long at the rate of 3296.5. Okay, price decreases means what? To close the long position contract, we have to take a short position. We sell at the rate of 3294.4. We are buying at a higher rate, selling at a lower rate. So that means you are getting a loss. How much loss you are getting? 105. And your balance will decrease to 15,895. Next day again, the price decreased to 3230.4. 3230.4. So what is the overall loss? Contract size 50. So in futures and options, contracts are standardized. There will be a contract size 50 or 100. If a contract size is not given in the question, you can assume the contract size as 50 or 100. So what is the loss second day? 3,200. So what is the balance? 12,695. The balance in margin account will decrease to 12,695. Next. Again third day. Again loss. Okay. Continuously 3 days loss. Again loss. 905. So 12,695 minus 905. Tell me the number. 12,695 minus 905. Tell me the number. Mahima Singh, tell me the number. 11,000. 11,790. Now Abhishek will get a margin call. The balance has fallen below the maintenance margin. He has to increase the balance to 16,000. He has to make a deposit. The amount deposited is called as a variation margin. What is the amount to be deposited? So what is the balance? 11,790. So from 11,790, the balance we should bring back to what? 16,000. So 16,000 minus 11,790. So the answer is what? 4,210. Clear? 4,210. So 4,210 is the amount to be deposited. Again our balance is what? 16,000. Again next day profit or loss is calculated. If Abhishek gets profit, balance will increase, or otherwise what? Balance will decrease. Clear? Done. So what happens to the counterparty? For the counterparty, first 3 days he will get profit and the balance will increase. Clear? Done. So this is a margin account concept. Next come to the next concept, fair future price. Fair future price. Fair future price. So what is this fair future price? In market you can find actual future price. Actual future price. So 3 months future price X Limited 2,500 in the market. What is the meaning of this? If you want to enter into a contract as on today to buy 1 share after 3 months, what is the price? What is the price? 2,000. Okay. For suppose 3 months futures, X Limited is 2,500. Okay. So what is the meaning of this? If I enter into a contract as on today to buy or a sell, what is the price applicable? 2,500. So I'm not going to buy share as on today. I'm not going to sell share as on today. This is an agreement to buy or a sell share at the end of 3 months. Forward contract, futures contract and option contracts, all the 3 contracts are the contracts entered today for the future. For the future. We enter into a contract as on today, but for the future. So fair future price. What is the fair future price? Here in our example, actual future price is 2,500. 2,500. Okay. Now the question is, what is this? Okay, fair future price. For suppose instead of entering into 3 months contract, instead of entering into contract as on today to purchase 1 share at the rate of 2,500 at the end of 3 months, I have an alternative. So first of all, when I will take a long position, if I have an expectation that the price will increase, if I have an expectation that the price is going to increase, I will take a long position. So one thing I can do is I can enter into contract as on today to purchase 1 share at the end of 3 months for rupees 2,500. What is the other alternative? Purchase the share as on today. Purchase the share as on today, because you have an expectation that the price will increase in next 3 months. You can buy the share as on today, carry it for next 3 months, and so as you can sell the share as if a share price increases. Yes or no? Fair future price is nothing but what? Instead of entering into a futures contract, you have another alternative. What is the other alternative? Purchase the share as on today and carry it for next 3 months. Okay. So theoretically, by the end of 3 months, the price must be equal to spot price plus carrying cost. Next 3 months carrying cost minus in next 3 months we might receive yield, dividend. We might receive some benefit, dividend. So that's why theoretically the future price, 3 months future price must be equal to spot price plus carrying cost minus yield. Okay. But here spot price plus carrying cost. Carrying cost means what? Share means you will not incur any storage cost or something. Okay. You will be incurring what? Interest. You will be incurring interest. Okay. You know the continuous, normal compounding. Normal compounding means P into 1 plus I power N. Okay. P into 1 plus I power N. Principal into 1 plus interest power N. So that is a normal compounding. But here in derivatives we do a continuous compounding because derivatives are traded continuously. Derivatives are traded continuously. So that's why we do a continuous compounding. So that's why spot price is nothing but a principal. That is an outflow as on today For that we need to add interest. How do we add interest? By doing a continuous compounding. So that's why spot price into e power TR minus yield. Sir, while evaluating an option like in question number, Shiva, I'm still discussing futures. So spot price into e power TR minus yield. So yield can be given in amount. They might give a dividend amount. If dividend amount is given, then we apply spot price into e power TR minus yield. Okay. Sometimes yield is given as a percentage. And you should not get confused between the dividend rate and the dividend yield. Dividend rate means that dividend rate has to be applied on the face value. Dividend yield means D1 by P naught. So this I have discussed in question number 10 portfolio management yesterday. Dividend yield is different. Dividend yield means D1 by P naught. Yield means return. What is the meaning of yield? Return. So if yield is given in percentage, then what is the formula? Spot price into e power T into R minus Y. Why R minus Y? R is a carrying cost, minus Y is yield. R is in percentage. Rate of interest will be given in percentage. Yield is also in percentage. So we can directly do what? Spot price into e power T into R minus Y. And yes, yield applied on MPS. Very good CMA student. Yield applied on what? MPS, market price per share. Earnings yield means E1 by P naught. Again, we discussed this dividend yield, earnings yield in security valuation chapter. Okay. So fair future price is equal to spot price into e power T into R minus Y. Again, I am repeating the point. Dividend yield is different from the rate of a dividend. The rate of a dividend has to be applied on face value. For suppose they have given a rate of a dividend 20. Sometimes for rate of a dividend also they might mention dividend yield. For rate of a dividend also they might mention dividend yield. For example, dividend yield 25%. Even though they have mentioned dividend yield, that is a rate of a dividend, because dividend yield cannot be 25%. It cannot be more than the rate of interest. Dividend yield cannot be what? More than interest. So that's why even though they have mentioned dividend yield, that has to be considered as what? Rate of a dividend. Rate of a dividend means what? That has to be applied on face value. Clear? I have seen all the questions and I am giving a relevant information. So in question they might give a dividend amount, or else what? They might give rate of a dividend or else dividend yield. If a rate of a dividend is given, you would apply that rate of a dividend on face value, find out the dividend amount and apply the second formula. Okay. But dividend yield is given. Dividend yield also, if it is 3%, 4%, 5%, then okay. You can apply what? Spot price into e power T into R minus Y. But dividend yield, if it is 25% or if it is greater than R, then what? So even though it is mentioned dividend yield, we have to consider it as what? Rate of a dividend. Am I clear? Done? Clear? So now comes the concept. So here we should compare the actual future price and fair future price. Actual future price and what? Fair future price. Actual future price and fair future price. Okay. So actual future price means the price which is in the market, which is trading in the market, the price which we can get from the market. What is this fair future price? Fair future price is calculated in the classroom. Theoretical price. So today we have learned one concept, fair future price concept. Okay, using that logic, that is if there is no futures concept, we have to buy the share and we have to carry it for next 3 months or 4 months. Yes or no? So by applying that logic, we are finding out what fair future price, that is called as a theoretical price. We compare theoretical price and what? Actual future price. For suppose if actual future price is equal to fair future price, both are same, correctly valued, and there is no scope for arbitrage. Actual future price is greater than fair future price. Actual future price is greater than fair future price. That means it is overvalued. You have to understand this course of action. In CMA final, they are just asking the course of action. They are not asking the entire arbitrage process. They are just asking the course of action. You should know the meaning of underpricing and overpricing. Let us assume the fair future price is 300. Fair future price 300. But whereas the actual future price is 400. Actual future price is 400. So it is overpriced. Understand the meaning. You should not by heart this. In our perception, as per our theory, the price in the future must be equal to 300, but whereas in the market it is 400. In the market it is 400. So that means it is overvalued or undervalued? Overvalued or undervalued? Overvalued. CMA student, in the money, out of the money. So that I will explain during the options. Because for options it is relevant. For suppose if you are exercising an option, if you are exercising a call option or a put option, it is called as in the money. If you are allowing the call option or a put option to lapse, it is called as out of the money. Okay, if it is indifferent, then what? If it is indifferent, then what? It is called as at the money. At the money. Simple. If you are exercising the option, it is called as in the money. If you are allowing the option to lapse, then it is called as out of the money. Okay, if it is indifferent, whether you exercise or lapse, you are not going to get any benefit, then it is called as what? At the money. So that I will explain again in options. Right now focus on fair future price concept. I am discussing futures. So actual future price is greater than fair future price. As per my theory, the price must be equal to 300 in the market, but whereas in the market it is 400. So tell me, so in futures market, are you going to buy or sell? In futures market, I have to sell because it is overpriced. It is overpriced. Okay, as per my theory, my mobile cost will be, my mobile price is 5,000, my perception. But Priya is willing to buy for rupees 1 lakh. What I will do? I will sell it blindly, yes or no? Take it. Okay. Why the reason? Because it is overpriced. It is overpriced. If it is overpriced, what we do? We sell. If it is underpriced, then what? We buy it. If it is underpriced, we buy it. Okay. So likewise here also, if actual future price is greater than fair future price, in future what? Sell. Nothing but today itself I will enter into a contract to sell the share in the future. But to sell the share in the future, I want share as on today. Yes or no? So that's why in spot market, I will buy share. At a time, simultaneously, arbitrator will enter into 2 contracts. Arbitrator will earn profit without taking any risk. So arbitrator simultaneously enter into 2 contracts. One contract is what? One contract is in spot market, he will buy the share. In futures market, he will sell the share. Nothing but he will enter into a contract as on today to sell the share in the future. So futures contract is nothing but contract entered today for the future. Contract entered today for the future. For suppose, if actual future price is less than, fair future price, undervalued. If actual future price is less than fair future price, then what? Okay, it is undervalued. So future what? Buy. In future buy means spot sell. Spot, how can I sell? I will go for short selling. Short selling means I will borrow the share from the broker and I will sell in the market. And in the future, I will buy and give back the share to the broker. So this is the course of action. Okay. And next, levered beta is equal to unlevered beta plus unlevered beta into debt divided by equity into 1 minus tax rate. So this yesterday's class we have already discussed, right? Next. So this is the fair future price concept. So for fair future, we have 2 questions. Question number 2. So question number 2 is for referral. You have to refer this question. See this question. The following data relate to Anand Limited share price. Current price per share 1800, 6 months future price per share 1950. Assuming it is possible to borrow money in the market for transactions in securities at 12% per annum, you are required to calculate the theoretical minimum price of a 6 months forward purchase and to explain arbitrage opportunity. Assuming it is possible to borrow money in the market for a transaction in securities at 12% per annum, you are required to calculate the theoretical minimum price of a 6 months forward purchase. How do we get 6 months forward purchase? 6 months theoretical minimum price is nothing but what? Fair future price. Fair future price. How do we get fair future price? Spot price into e power TR. Yield is not given in this question. Yield is not given. So that's why 1800 into e power 6 by 12, 6 months. So that's why 6 by 12 into what? 12%, 0.12. So 1800 into e power 0.06. How to find out e power 0.06? So this is very easy. E power x is equal to 1 plus x by 1 factorial plus x square by 2 factorial plus x cube by 3 factorial and so on. You have to take up to what? X cube. So 1 plus 0.06 divided by 1 factorial plus 0.06 square divided by 2 factorial plus 0.06 cube divided by 3 into 2. So the answer is 1.0618. So 1800 into 1.0618. So the answer is 1911.24. Very good CMA student. 1911.24. So as per our theory, 6 months future price must be equal to 1911. That means after 6 months, the price of a share must be equal to 1911. But what is the actual future price? 1950. But whereas 6 months future price in market is 1950. So okay, overpriced, underpriced? Overpriced. As per our theory, share price must be equal to 1911.24, but it is equal to 1950. It is overpriced. So that's why future sell, spot buy. So in the spot market, arbitrator will buy one share at the rate of 1800. Okay, and will carry it for next 6 months. Carrying cost will be 111.24 and overall cost will be 1911.24. And he will sell share after 6 months at the rate of 1950. He will receive a benefit of what? 38.76. Very good CMA student. Arbitrage means nothing but arbitrator will identify the market imperfection. Market imperfection means what? Market imperfection means, for example, here as per our theory, the price must be equal to 1911.24. But whereas in the market the price is 1950. 1950. So arbitrator will earn a profit without taking any risk. How he can earn a profit without taking any risk? Simple. You have to understand this concept. Simple. So as per my knowledge, the price must be equal to what? 1911.24 as per my theory. But whereas in the market, what was the 6 months future price? 1950. So that means I can enter into a contract as on today to buy or sell one share at the rate of 1950 at the end of 6 months. Okay. But as per my theory, the price must be equal to what? 1911.24. So tell me what I will do. Simple. As per my theory, after 6 months, the price must be equal to 1911.24. So as an arbitrator, what I will do is, I will enter into a futures contract to sell one share at the rate of 1950 after 6 months. Because theoretically, the price after 6 months must be equal to 1911.24. But in market, it is 1950. So at the same time, at a time, I will enter into two contracts simultaneously. So one contract, I will purchase the share at the rate of 1800. Another contract, I will enter into contract as on today to sell one share at the rate of 1950 after 6 months. So what happens? I have purchased one share at the rate of 1800. How can I purchase one share at the rate of 800? I have to borrow money. I have to borrow money at the rate of 12% per annum for 6 months. So this 1800 with interest will be equal to 1911.24. Okay. And I will be receiving 1950 on sale of a share. And the balance amount is profit 38.76. So arbitrator always identify the market imperfection. This concept again it will get repeated in forex chapter. Arbitrage. Okay, it is a simple concept. Okay, instead of this one you can take any other example, vegetables. Okay, so but here we have to take some assumptions. We ignore the time, we ignore the transaction cost. We ignore transaction cost. Transaction cost. Okay, for example, so purchasing a mobile in US and selling in India. Okay, so you will be calculating what theoretical price, at what price you are going to buy in US. Okay, shipping, transportation, everything include, and then what you will find one theoretical price, and here you will be asking what the customer at what price he is willing to buy. Business is different from arbitrator. Business includes hedging, speculating, arbitrage. Okay, arbitrage means what? At a time we enter into two contracts. Here we enter into a contract with customer in India to sell phone, and at a time we enter into a contract in US with a supplier to buy a phone. No risk. Without taking any risk, we can earn a profit. Okay, so this is business. Yes, this is business, but what? Clear? Okay, next. Clear? So this is the question, arbitrage process. Next, see the next question. See the next question. So this question is for practice, right? A++. This question you have to practice. Huh? Yeah, this is past examination question. Past examination question. This is for practice. Past examination question. This is for practice. So this question is for practice. Fair future price and arbitrage. In both the cases, Madhukumar, arbitrage opportunity will exist when overvalued and undervalued. If you see this question, you will understand the concept. So I have another question. The following information pertaining to two securities is given. Securities A limited, B limited, spot price 4550, 360, dividend expected 50/20, dividend receivable in 2 months and 3 months. Recommended action. Recommended action. Sell spot, buy future. Sell spot, buy future. Buy spot, sell future. Risk-free interest rate may be taken as 9% per annum. Determine the 6 months theoretical forward price of a securities of A limited and B limited. For what values of a futures contract rates will the above recommended action be appropriate? And what would your answer to one above if there is no dividend expected for A and B? So first of all, what they are actually asking. What they are actually asking, so that you have to understand. The following information pertaining to two securities. First, see one security. What is the spot price? 4550. Dividend expected 50. Dividend receivable in how many months? Dividend is receivable in 2 months. Dividend is receivable in 2 months. So in last question, dividend is not given, but here dividend amount is given. Dividend amount. Spot price 4550. So what is the formula we are going to apply? Spot price into e power TR minus yield. Minus yield. So what is the spot price? 4550 into So they are asking you to find out the 6 months theoretical forward price. 6 months. That means you have to do continuous compounding for how many months? 6 months. So 4550 into 4550 into e power 6 by 12 into 0.09 minus yield. Be careful, 50 we cannot straight away reduce because 50 is receivable in how many months? 2 months. So understand this calculation. 50 is receivable in how many months? 2 months. Okay, but this 4550 into e power 6 by 12 into 0.09 is the value at the end of a 6 months. Value at the end of a 6 months. Yes or no? So, but 50 is receivable in how many months? 2 months. So, from 6 months value, I cannot reduce 2 months dividend. The dividend which is receivable in 2 months. Yes or no? So, that's why I have to compound that 50 rupees for next 4 months. I have to compound the dividend for next 4 months. So, that's why the calculation is 4550 into e power 6 by 12 into 0.09 minus 50 into e power 4 by 12 into 0.09. You know how to find out e power 0.05. E power 0.045 is equal to, how do we get e power 0.045? 1 plus 0.045 divided by 1 plus 0.045 square divided by 2 into 1 plus 0.045 cube divided by 3 into 2 into 1. So what is the factor? 1.04602. Clear? Likewise, I should find out e power 0.03. So what is the answer? 470748. So this is the fair future price. This is the fair future price. So this question is little different. Why? In question they have not given the actual future price. In question they have not given the actual future price, but recommended action is given. So they have given the course of action. They have given the course of action. What is the course of action? Sell spot, buy future. Buy future means buy future. See the question also. First part. For what value of a futures contract rates will the above recommended action be? Will the above recommended action be appropriate? Will the above recommended action be appropriate? So, okay, simple. What is the recommended action? Buy future. So, buy future. When we buy future, if it is undervalued. So, arbitrator can make profit. Okay, if the stock is undervalued, the recommended action is appropriate. If a share is undervalued means the actual future price must be less than 4707.86. If actual price is less than 4707.86, then the above recommended action will be appropriate. Clear? Undervalued. So likewise, the next company, B Limited. For B Limited, you can do on your own. Okay, for B Limited, what is the price? See, B Limited 360 into e power 6 by 12 into 0.09. 0.09 minus 20 into e power 3 by 12. Why 3 by 12? Because dividend is receivable in 3 months. That means we have to do compounding only for what? 3 months. So 356.11 is the fair future price of a CMA student. We can solve this by using an alternative method. The alternative is what? Bring the dividend to the present value. So dividend is receivable in 2 months. First case, right? So find out the present value of a dividend, discount the dividend for 2 months, then reduce from spot price, and this net spot price compound it for next 6 months. Then also you will get the answer. But I'm not explaining it because the last minute I don't want to confuse. So that's why. Clear? And what is the course of action for the second one? Buy spot, sell future. Buy spot, sell future means what? Sell future. We sell future if it is overvalued. If it is overvalued. Yes or no? Sell future if it is overvalued. Clear? So that means actual future price must be more than fair future price. That is 356.10. Clear? Abhimati, clear? Very good. Am I clear? Are you able to understand? Next, second part is, what would your answer to one above if there is no dividend expected? If there is no dividend expected, then simple, my answer. So I will ignore the dividend. I will take directly what? 4550 into e power 6 by 12 into 0.09. So fair future price will change. Clear? So likewise B limited also. So I will display the question and you have to solve this question with the presentation in 10 minutes. Hedging means reducing the risk. Hedging means reducing the risk. In hedging, how can we do a hedging? Hedging means reducing the risk. First one, cross hedging. Cross hedging. Cross hedging means taking an appropriate position in index. Taking an appropriate position in index. Index means market. For suppose you have already purchased the shares. Okay. You have already purchased the shares. But you have an expectation that the price might decrease. You have a fear that the price of a shares might decrease. Then what you can do? Simple, you can sell the shares. So then what? You are exiting from the game. You are no more in the game, right? So this is not called hedging. Hedging means what? You have already shares and you have a fear that the share price is going to decrease. Then what you are going to do is you will be taking an appropriate position in index. Generally beta, you know the meaning of beta. Beta is equal to 2. What is the meaning of beta 2? For every 1% change in market, okay, security changes by 2%. Beta positive means what? Moving in same direction. Moving in same direction means what? If share price decreases, market will also decrease. If a market increases, share price will also increase. In most of the cases, beta will be positive only. Beta will be positive. Beta will be positive. Simple logic, because we are in the market. Our company is also in the market, right? So our company shares depends upon what? Market movements. So that's why generally the beta will be what? Positive. Beta will be positive. Beta will be what? Positive. So that's why if you have already purchased the shares, if you have already purchased the shares and you have a fear that the share price is going to decrease, so in index you have to take opposite position. That means short position. You have to sell the index. Why you should sell the index? What is your fear? The price is going to decrease. If in future the share price decreases, market will also decrease. Market will also decrease. So in market you are taking a short position. You will sell at a higher price and you will be buying at a lower price because the price is going to decrease. So that's why the first category of a hedging is cross hedging, taking an appropriate position in index. So frequently asked MCQ, multiple choice question. Frequently asked MCQ, most frequently asked. In almost every question paper you will find one MCQ from derivatives on this cross hedging concept. Next, buying risk-free securities. We already know that beta of a cash is equal to 0. Beta of a risk-free security is also 0. Beta of a risk-free security is also 0 because risk-free security is independent of a market. No relation between the risk-free security and market. Beta of a risk-free security is equal to 0. How do we get portfolio beta? Portfolio means combination of a securities. Portfolio beta means weighted average of a security beta. Weighted average of a security beta. Weighted average of a security beta. So now the point is weighted average of a security beta. Now the point is in your portfolio, for suppose if you are including the risk-free security, then what happens to the overall beta? Overall beta will decrease. Hedging means mitigation of a risk. Okay, so buying risk-free securities. In buying risk-free securities, we have a 3 categories. Making a fresh investment, altogether fresh investment. Making altogether fresh investment means what? Without disturbing the existing shares. We are not going to buy or sell the existing shares. The existing shares will remain same. We make a fresh investment. When you make a fresh investment risk-free security, the weights will change and also weighted beta will also change. Okay, and second one, without making fresh investment, sell the existing shares proportionately and buy risk-free security. This was tested in June 2025. Main question number 7. Buy risk-free securities. But how you are buying the risk-free securities? By selling the existing shares proportionately and what? Buying a risk-free securities. So that's how we can reduce the overall beta, portfolio beta. When you see the questions, you will understand the concept. Next, sell shares in the order of risk. Sell shares in the order of a risk and buy securities. What is the third category? We are not going to sell the shares proportionately. We are going to sell the shares in order of a risk. High risk shares are sold first and we buy risk-free securities. Okay. And next what? Selling high risk shares and buying low risk shares. Selling high beta shares and buying low beta shares. Selling high beta shares and buying what? Low beta shares. When you sell high beta shares and buy low beta shares, then what happens to the portfolio beta? Portfolio beta will decrease. Portfolio beta will automatically what? Decrease. Am I clear? Okay. So this hedging concept is very important. I covered all the questions. Okay. So comprehensive coverage. Clear? Mahima Singh, buy call option and sell put option. Mahima Singh, right now we are discussing futures. We are not yet entered the concept options. Right now we are discussing what? Only futures. Okay. In futures we are going to discuss hedging. Clearer? In options also we talk about hedging in binomial model. Hedge ratio. In binomial model we talk about hedge ratio. Right now I am talking about the futures hedging. Hedging in futures. So there are 3 categories: cross hedging, buying risk-free securities, selling high risk shares and buying low risk shares. Cross hedging, taking an appropriate position in index. So taking an appropriate position index, see the question number 3. Question number 3. Question number 3 is for taking an appropriate position. Cross hedging means nothing but to handle the risk arising from shares. We use index. Index cross. Cross means what? We are not using the same shares. We are using what? Index to reduce the risk. So that's why it is called as a cross hedging. Yes. Because we are taking an inverse position. That also we can say. Okay. See the question number 3 to understand the basic concept of a appropriate position in index. Which position on the index future gives a speculator a complete hedge? Complete hedge. They are asking about the complete hedge. Again is the following transaction. The share of a right limited is going to rise. The share of a right limited is going to rise. He has a long position on the cash market of rupees 50 lakhs on the right limited. The beta of the right limited is 1.25. Beta of a right limited is 1.25. Okay. So we already have a long position in the cash market, 50 lakhs of a right limited. Already we purchased 50 lakhs worth shares in right limited. So in index, what is the beta? Beta is equal to 1.25. Beta is positive or negative? Positive. That means both shares and market move in same direction. In shares I have taken a long position. So in market I cannot take long position. If I take long position, risk will increase. So that's why I have to take an opposite position. That means a short position. Short position. For how much value I have to take? I have to take 50 lakhs into 1.25. Why 50 lakhs into 1.25? Because for every 1% change in market, security changes by 1.25. So that's why for complete hedge, the value of index position must be 50 lakhs into 1.25, that is 62 lakh 50,000. Very good. CMA student. Next. Second, the share of a wrong limited is going to depreciate. He has a short position. On the cash market of rupees 25 lakhs on wrong limited. The beta of a wrong limited is 0.9. The beta of a wrong limited is 0.9. So in shares we have a short position. In index I will take long position. Clear? For what value I will take a long position? 25 lakhs into 0.9. 22 lakh 50,000. Clear? In shares I have a short position. So what is my fear? The price might increase. If a price increases, I will lose money in shares. So that's why I'm taking a long position in index. So that's why if a share price increases, I will lose money in shares, but I will get gain in market. Next, the share of a fair limited is going to stagnant. He has a short position on the cash market, 20 lakhs. Cash market, 20 lakhs. Beta, 0.75. Beta 0.75. So tell me, I will take long position in market for what value? 20 lakhs into 0.75. 15 lakhs. Clear? Okay. Next, question number 4. So this question you have to refer. But this attempt, better you practice this question number 4. Why? Because the reason CA final in last 4 attempts, this question was asked 2 times. In CA final past 4 attempts, this question was asked 2 times. So that's why question number 4, even if you refer, that is enough. But still, why to take chance? Better you practice this question. Okay. Question number 4. Ram buys, question number 4, Ram buys 10,000 shares of X Limited at a price of rupees 22 per share, whose beta value is 1.5. Okay. So Ram already purchased the shares of X Limited. How many shares? 10,000 shares. Price 22. So 2 lakh 20,000. And sells 5,000 shares of A Limited. At a price of rupees 40 per share. Yes, CMA student. It was asked in September 2025. So he obtains a complete hedge by Nifty futures at rupees 1,000 each. So first of all, in cash market, there are 2 transactions. Bought X Limited shares, 2,20,000. A Limited shares, 5,000 into 40. 2 lakhs sold. One is long and the other is short. Long 2,20,000, short 2 lakhs. He obtains a complete hedge. Complete hedge means, so first X Limited shares. See the X Limited shares. X Limited shares 10,000 shares into 22. 10,000 shares into what? 22. 2,20,000. For this 2,20,000, in index we take short position. And for what value? 2,20,000 into 2,20,000 into 1.5. 3,30,000. A limited. A limited. A limited what? Already we have a short position 2 lakhs. So that's why in index we take long position. For what value? 2 lakhs into beta. 4 lakhs. So in index 3,30,000 short, 4 lakhs long. So the overall position is 70,000 short. Sorry, long. 70,000 long. So overall we have a 3. In our portfolio we have a 3. Now we have a 3. He obtains a complete hedge. He obtains a complete hedge. That means what? We have a 3. 3. One is X limited, A limited, and next what? Index 70,000 long. Index 70,000 long. See the next part. Simple question. What happened here? He closes out his position. He closes out his position. That means he closes all the contracts at the closing price of the next day. When the share of X limited dropped by 2%, X limited share price dropped by 2%. X limited you have a long position, right? X limited you have a long position. If a price increases, you will get money. But here price dropped by 2%. So that means you are going to lose money. What is the amount you are going to lose? 2,20,000 into 2%. 4,400 or else. So structured calculation. You are taking a long position at 2,20,000. On maturity, you will be closing the contract by taking a short position. By the time you take a short position, the price is getting decreased. You are buying at a higher price, selling at a lower price. So loss 4,400. Next, what happened? Next, share of A limited appreciated by 3%. Again we got loss. Unlucky fellow. Yes or no? Already he lost money in X limited, and in A limited also he is losing money, because in A limited he took a short position. So short position at the rate of 2 lakhs. To close the short position contract, he has to take a long position. By the time he takes a long position, share price increases by 3%. So buying at lesser price, selling at lower price, buying at a higher price. Again loss 6,000. Next, Nifty dropped by 1.5%. Nifty dropped by 1.5% means Nifty dropped by 1.5. Again, unlucky fellow. He took a long position, but Nifty dropped by 1.5. So is he going to get a benefit or not? Long at 70,000, long at 70,000, short at the rate of 70,000 into 98.5%. Buying at high price, selling at low price. So again loss 1050. So the overall loss is 11,450. So Nifty part simple. Nifty dropped by 1.5, right? Nifty dropped by 1.5. What is the position in Nifty? Long position. You have taken a long position at the rate of 70,000. To close this long position contract, we take a short position. So by the time you take a short position, what happened to the Nifty? Nifty dropped by 1.5. Nifty dropped by 1.5. That means 70,000 into 98.5%. So you will be taking a short position at the rate of 68,950. So the loss is equal to 1050 in Nifty. Actually, this should not happen based on our expertise knowledge, because based on beta, we took an appropriate position, but sometimes history may not repeat, because how the beta is calculated, how the beta of X limited, A limited are calculated, covariance of S comma M divided by sigma M square. How the covariance of S comma M is calculated? S minus S bar into M minus M bar. S bar, how will you get S bar? By doing a simple average. M bar, by doing an average. Okay, what average you will do it? Past data, yes or no? So based on the past, you are finding out the responsiveness of a security with respect to the market. Okay, so based on the past, we are saying that beta 2 means what? If market changes by 1, security changes by 2% in same direction. But that doesn't happen. So that's why what in all the cases we got loss. Clear up. Sometimes history may not repeat. Trend may not repeat. If a trend does not repeat, then what? Loss. Clear up. CMA student, is it clear? Nifty part. Nifty part is simple. Long X limited 220. That means index short. At what value? Value of index position. Portfolio value into beta. What is the portfolio value? 220 into beta 1.5. Okay, A limited short 2 lakhs. That means portfolio long. What is the value? 4 lakhs. Clear? Done. Next. See the question number 5. Question number 5 is also cross hedging. This question you have to refer because we have two different answers given in CA final study material and board material, CMA board material. So you follow the CMA board material, ignore the CA final answer. BSC 5000, value of a portfolio 10 lakh 10,000, risk free rate 9%, dividend yield on index 6% per annum, beta of a portfolio 1.5. We assume that a future contract on the BSC index with 4 months maturity is used to hedge the value of portfolio over next 3 months. We assume that future contract on the BSC index with 4 months maturity is used to hedge the value of a portfolio over next 3 months. Because of this sentence, so the answer has got differed between CA and CMA material. We assume that future contract on BSC index with 4 months maturity. BSC index with 4 months maturity is used to hedge the value of a portfolio over next 3 months. One future contract is for delivery of 50 times the index. Okay. So after this, I will do CA final AFM revision series. In that revision series, I will give a different answer. If any student who is doing CA and CMA, please do not get confused, okay? For CA final, I will say CA final answer. For CMA final, I will say CMA final answer. One future contract is for delivery of 50 times the index. Based on the above information, calculate price of a future contract. Price of a future contract. Price, nothing but fair future price. How do we get fair future price? Current index is given, BSC index. They are asking about the index. They are not mentioned. Price of a futures contract means here talking about index. So 5,000 is the price, right? That is the current value. What is the risk-free rate? 9%. Dividend yield 6%. Yield is given in percentage. So spot price into E power T into R minus Y. So 5,000 into BSC index mature at the end of 4 months. First sentence. So 5,000 into E power 4 by 12 into 0.09 minus 0.06. 5050.25 into what is the contract size? 50. So 2,52,502.5. Clear? Done? Am I clear? So now here you have to understand one point. Here 4 months maturity. You might get confused when you see the question. Price of a future contract. Here the price of future contract means index future contract. And the index future contract maturity is how many months? 4 months. Clear? Next, see the second part. The gain on short futures position if index turns out to be 4,500 in 3 months. The gain on a short position. Gain on a short position. If index turns out to be 4,500 in 3 months. Okay, index turns out to be 4,500 in 3 months. The gain on a short position. Why this gain on a short position? They have clearly told, we assume that future contract on BSC index with 4 months maturity is used to hedge. Use it to hedge. Hedge means already we have a portfolio 10 lakh 10,000. Already we have a portfolio 10 lakh 10,000 means index we take short position. Index we take short position. Yes or no? Index we take short position. How many contracts we are going to take a short position? 10 lakh 10,000. 10 lakh 10,000 into beta. What is beta? 10 lakh 10,000 into 1.5. 10 lakh 10,000 into what? 1.5. Okay, 15 lakh 50,000. 10 lakh 10,000 into 1.5 divided by 2 lakh 52,512.5. 6 contracts. Nothing but we take a short position for how many contracts? 6 contracts. You should know the meaning, formula. Number of contracts to be sold or buy is equal to portfolio value into beta divided by value of one futures contract. Value of one index contract. Portfolio value into beta divided by value of one index contract. That is for complete hedging. Sometimes they will not ask for complete hedging. They will ask you to reduce the beta from 0.8 to 0.6. 0.8 to 0.6. That means we need hedging only for 0.2. So in that case, what is the formula? Portfolio value into existing beta minus target beta. Here our target beta is 0. So that's why we are taking portfolio value into existing beta. But generally what portfolio value into existing beta minus target beta divided by value of one index contract. Clear? So how many contracts? 6 contracts. So go through this ICMAI answer. Right now we are taking a short position at the rate of, what is the 4 months future price? 5050.25. So we are taking a short position at the rate of 5050.25. On maturity, to close the contract, we should take a long position. What is the price on maturity? 4,500. The gain is selling at 5050.25, buying at 4,500. So 6 into 50 into 5050.25 minus 4,500. So the answer is 165,075. 165,075. Clear? 165,075 is the answer. Here ICMA answer is not completely correct because the reason is 4,500 is the price at the end of a 3 months. 5050.25 is the fair future price. At the end of 4 months. Price at the end of a 4 months. So that's why. So CA answer is correct, but you have to follow CMA for exam purpose. Okay. Yeah, the answer which is highlighted you have to write. Clear? Next question number 6. Question number 6. Okay, you feel like hitting your head to pillar, okay, but be patient. Question number 6. Question number 6. So this is also a past examination question, frequently asked question. Question number 6 and additional question number 7 both are same. Okay, so this question is also what? Cross hedging. On April 1, 2015, An investor has a portfolio consisting of 8 securities as shown below. So this question is for practice A++ category. On April 1, 2015, an investor has a portfolio consisting of 8 securities as shown below. 8 securities are given: market price, number of shares, and beta. Value means nothing but beta. Cost of a capital for the investor is 20% per annum, continuously compounded. The investor fears a fall in the price of the shares in the near future. Accordingly, he approaches you for the advice to protect the interest of his portfolio. He approaches you to protect the interest of his portfolio because he has a fear of the fall in the price. You cannot say sell shares. Okay, if you have a fear of fall in the price, you can sell shares. So he is coming out of the game. So that we cannot suggest. If you suggest selling shares, then what? No food for C or CMA. You should say what? Hedging. You should recommend what? Hedging. So take an opposite position in index. You can make use of the Nifty following information. The current value of Nifty. What is the current value of Nifty? 8,500. Nifty futures can be traded in the units of 25 only. Futures for May are currently quoted at 8,700 and futures for June are being quoted at 8850. You are required to calculate the beta of his portfolio. Can we find out beta of portfolio or not? Yes, by doing a weighted average. So now do not waste time by calculating portfolio beta. Note down the portfolio beta answer from the question, from the question bank. And try the second part. What is the second part? Theoretical value of a futures contract expiring in May and June. Theoretical value. How do we get theoretical value? Spot price into e power t r minus yield. Yield is given in the question or not? Yield is given in the question or not? Yield is not given in the question. Yield is given in the question or not? Yield is not given in the question. So tell me. So simple. What is the calculation? Current value of Nifty 8,500 into e power 0.2 into what is the time? 3:45. How many months? So we are in April, right? April, May, 2 months. So that means 8,500 into e power 2/12 into 0.2. So there is high chance of committing a mistake. Why there is a high chance of committing mistake? Because you will get e power 0.033. E power 0.03. E power 0.03. So what is the meaning of this e power 0.03? E power 0.03 is different from e power 0.033. You might have got e power 0.033. High chances of doing a clerical mistake. In question, the factor given is for e power 0.03. But what you require? You require e power 2/12 into 0.2. E power 0.0333. Be careful. High chances of doing a clerical mistake. Once again, I am repeating. So you have to find out the e power 0.033. But for June, okay. For June, okay. For June, what? For June, how many months? 3 months. E power 0.2 into 3/12. 0.05. So e power 0.05 is given. E power 0.05 is given. So you can find out the theoretical future price. Clear? So what is the answer? 8987, huh? 8788 May. 8788 8788 is the May price. What about June? 8935. Very good. 8935 or 36? 35.8 means 36. You should take 36. Proper rounding off. 5 or more than 5, go to next number. Next, the third part, the number of Nifty contracts that he would have to sell if he decides to hedge until June. He wanted to hedge until June. So each of the following cases. First, he wanted to hedge total portfolio. Total portfolio means portfolio value into beta divided by value of contract. So be careful, actual future price is also given. To find out the number of contracts, we should use the actual future price. But in additional question number 7, actual future prices are not given. If actual future prices are not given, then we assume, there is an implied assumption, we assume theoretical future prices and actual future prices are same. And we find out the number of contracts based on theoretical future price. But in this question, actual future prices are given. Clear? So you will get beta 1.102. So number of Nifty contracts to be sold. In first case, 5 contracts. 994450 into 1.102 divided by 25 into 8850. Next, 50% of the portfolio. 50% of the portfolio means portfolio value into beta into 50%. You should take only 50%. How many contracts? 3 contracts. 120%. 6 contracts. You should round off the contracts. Clear? So try this question. Everybody please. This concept is very important for derivatives. Practice. So this question you have to practice A++ question. So first part of a hedging we completed. Total 3. Cross hedging. Taking an appropriate position in index. Second, risk-free securities. In risk-free securities we have 3 categories. Fresh investment. In this question we are going to discuss fresh investment and also third category. What is the third one? Selling shares in the order of risk. Selling the shares in the order of risk. Sorry, selling high risk shares and buying low risk shares. Additional question number 7 is for fresh investment and selling high risk shares and buying low risk shares. So with one question we are going to cover 2 concepts. So question number 7, this question is for practice. Thank you, CMA student. This question is for practice. Question number 7, this question is for practice. An investor has the following 4 stocks in his portfolio. Security A, B, C, D. Number of shares. 60,000, 3,000, 6,000, 3,000, 5,000, 1,000. Market price per share and beta. Compute the portfolio beta. First I will explain the question, then you practice this. Portfolio beta. Portfolio beta, either we can find out the proportion and can do weighted average, or else the other way of finding out the beta is security, market value, beta, market value into beta. Market value into beta. So market value into beta divided by market value. You will be left with beta. Market value will get cancelled, right? So beta of a portfolio is equal to 7,11,000 divided by 6,50,000. So the answer is 1.094. So this is additional question number 7 of a portfolio management. Clear? See the second part of the question. If the investor seeks to reduce the beta to 0.8, how much risk-free investment should he bring in? Portfolio management main question number 11 is also same. If you solve this question number 7, it includes what? Portfolio management main question number 11. So if the investor seeks to reduce the beta to 0.8, what is the target beta? 0.8. What is the present beta? 1.094. Let the proportion of risky securities, existing securities, let us assume the proportion of risky securities is equal to P. Then the proportion of risk-free security will be 1 minus P. We don't know how much risk-free investment we should bring in. So that's why we are assuming. So what is the existing beta? 1.094. Target beta 0.8. How do we get portfolio beta? By doing a weighted average. So P into 1.0938 plus 1 minus P into beta of a risk-free security is equal to 0 is equal to 0.8. So you are getting P 0.73138. So 1 minus P is equal to 0.2686. So what is the risk-free investment to be made in? What is the risk-free investment? Risk-free investment. So we are adding the amount. So this already we have a 6,50,000 investment. This 6,50,000 is equal to what? 0.7314. Okay, what is the proportion of risk-free security? 0.2686. Okay, for 0.7314, 6,50,000 is the amount. So for 0.2686, what is the amount? 2,38,706.5. 2,38,706.5. Clear? Done. Okay, now comes the critical part. Independent of a 2. If the investor would like to have a overall weighted beta of a 1.02. So this is entirely new again. If they want beta of 1.02 without bringing in more money, they don't want to bring more money. They don't want to invest further. By selling shares of a C and buying A instead. What is the C beta? C beta is equal to 1.5, A beta is equal to 0.9. So they wanted to sell C shares and buy A. If you sell high beta shares and purchase low beta shares, then what happens to the overall beta? Overall beta will decrease. How many shares of a C should be sold? So target beta, what is your target beta? 1.02. So what is your target market value into beta? Target market value into beta. So this is not target beta, target market value into beta. What is target market value into beta? 6,50,000 into 1.02. 6,63,000 is the target market value into beta. Yes or no? So I don't know how much value of investment in C should be sold. I have to sell C shares and buy what? A shares. So let us assume the value of investment to be sold in C is equal to X. Security A, B, C, D, market value 2,40,000 plus X. Because we are going to sell X amount of C and invest in A. So 2,40,000 plus X. B will not change, same 60,000. C 1,25,000 minus X. D 2,25,000, and the overall investment will remain same 6,50,000. Beta and then market value into beta. So the total you are getting is 7,11,000 minus 0.6x. That should be equal to what? That should be equal to 6,63,000. So that means X must be equal to 80,000. So that means number of shares of a C to be sold is equal to 80,000 divided by market price per share 25. So how many shares we are going to sell? 3,200 shares. So that is the question they have asked. Third part. And again fourth part. independent of 2. If the investor would like to have an overall beta of 1.02 without bringing in more money by selling shares of C and buying A instead, what would be the revised weighted beta? They are asking you to find out the revised weighted beta. It is continuation to the third part. How do we get revised weighted beta? Simple, you will get 1.02. Revised weighted beta. A investment is equal to 2,40,000 plus 80, B 60, C 45,000 and D C 45,000. How 45,000? 1,25,000 minus 80,000. So the answer is 1.02. So beta is equal to 1.02. So please solve this question within 10 minutes. So this is selling high risk shares and buying low risk shares. Next, see the main question number 7. Main question number 7. This question it was asked in June 2025. So less chances of asking in December 2025. See the main question number 7. So this question is the Super 50 question, and this question it was asked in June 2025. That too only 4 parts. In our book there are 5 parts, but they have asked only 4 parts. Question number 7. Details about portfolio of shares of an investor is as below. Shares A limited, B limited and C limited. Number of shares 3 lakhs, 4 lakhs, 2 lakhs. Price per share beta. The investor thinks that the risk of a portfolio is very high and wants to reduce the portfolio beta to 0.91. Investor wants to reduce the beta to 0.91. He is considering 2 below mentioned alternative strategies. First strategy, disposing of the part of his existing portfolio to acquire risk-free securities, or take an appropriate position on Nifty futures which are currently traded at rupees 8125 and each Nifty worth rupees 200. Worth rupees 200 means nothing but that is a contract size. Contract size. You are required to determine portfolio beta. So this is a June 2025 question. So hedging, we have 3 forms of hedging, right? Taking an appropriate position, that we have already covered. Next what? Taking an appropriate position, already covered. Next, selling high risk shares and buying low risk shares. Just now we have covered. Additional question number 7 of the portfolio management. And also we have covered what? Fresh investment. Okay, buying risk-free security. In buying risk-free securities, we have 3 categories. What are the 3 categories? Okay, fresh investment. Second, selling shares proportionately and buying risk-free securities. So main question number 7 is derivatives. Main question number 7 is what? Selling shares proportionately and buying risk-free securities. And one more category we have to see it. What is the other category? Selling the shares in the order of risk and buying risk-free securities. Further, we have to go through. Okay, additional question number 8 of a portfolio management. So this question number 7. Mahima Singh, God bless. Okay, thank you, ma. Question number 7. So you are required to determine first what? Portfolio beta. Portfolio beta. Number of shares, price per share and beta is given. So portfolio beta is equal to 1.3. So that we can find out easily. Next, the value of a risk-free security is to be acquired. The value of a risk-free security is to be acquired. So value of risk-free security is to be acquired. So why they are asking value of risk-free securities to be acquired? Because the second part is, what is the second part? What is the second part? Dispose of the part of, what is the first part? Dispose of part of his existing portfolio to acquire risk-free securities. So what is the target beta? 0.91. Present beta 1.3. Let the proportion of risky securities is equal to P. Let the proportion of risky securities is equal to P. Then the proportion of risk-free security is equal to what? 1 minus P. So 1 minus P into 0 plus P into 1.3 is equal to what? 0.91. So P is equal to 0.7. That means proportion of risky securities is equal to 0.7, 70%. What about the proportion of risk-free security? 30%. That is 1500. So we should find out the amount. Be careful while finding out the amount. Here we are not making a fresh investment. We are selling a part of a portfolio and purchasing the risk-free security. So that means the overall investment of 5,000 lakhs will remain same. In 5,000 lakhs, what should be the composition? 70% must be the risky securities, 30% must be the risk-free securities. So what is the value of risk-free securities to be acquired? 1,500 lakhs. Okay, only numbers are changed, but the same question was asked in examination. Third part, calculation of number of shares of each company to be disposed. They have not mentioned how to sell the shares. They have told just to sell the shares. Okay, so they have not mentioned anything. So that's why we are going to sell the shares proportionately. Sell the shares proportionately. So 1,500 lakhs is the risk-free investment, yes or no? So we are going to sell A limited shares, B limited and C limited shares proportionately. So 1,500 lakhs into 0.3 into 1 by 500. What is that 500? Market price per share. So they are asking you to find out the number of shares. So 90,000 shares is the answer. Next. B limited 1,500 lakhs into 0.6 into 1 divided by 750. 1 lakh 20,000 shares. Next, number of shares in C limited. So number of shares in C limited. So number of shares in C limited 60,000 shares. 60,000 shares. Am I clear? Done. Clear? Next. Next part. The number of Nifty contracts to be bought or sold. Number of Nifty contracts to be bought or sold. How do we get number of contracts to be bought or sold? Portfolio value into existing beta minus target beta divided by future value of a contract. Value of one contract. So what is the portfolio value? Portfolio value 5,000 lakhs into existing beta 1.3 minus 0.91 divided by 8125 into 200. 120 contracts is the answer. Okay. Clear? 120 contracts. Okay. See the next part, fifth part. This was not tested in June 2025. Only 4 parts were asked. So what is the fifth part? This is continuation to the fourth part. High chances of doing a mistake. Fifth part. The value of a portfolio beta for 2% rise in Nifty. We have to find out the value of a portfolio beta for 2% rise in Nifty. 2% rise in Nifty. Okay. So 2% rise in Nifty. So what is the beta of a share? 1.3. Beta of a share is equal to 1.3. Yes or no? So Nifty rises by 2%. Nifty rises by 2% means share price rises by 2.6%. 2.6%. That means the share value increases from 5,000 lakhs to 5,000 lakhs will increase by 2.6%. So 5130 lakhs. 5130 lakhs. Share price will increase to 5130 lakhs. But you will be losing money in Nifty because you are selling Nifty contracts. You are selling Nifty contracts. How many contracts you are selling? 120 contracts into 8125 into 200 into 2%. So 39 lakhs. And the new portfolio value will be 5091 lakhs. New portfolio value is equal to 5091 lakhs. From 5,000, the portfolio value increased to 5091. So that means the change is, what is the change? change portfolio percentage change in portfolio value is equal to 5091 minus 5000 divided by 5000. So the percentage is 1.82 percentage, 1.82 percentage, 1.82 percentage. So beta is equal to change in portfolio value divided by change in market. So portfolio value is changing by 1.82% and change in market is 2%. So the new portfolio beta will be 0.91. So portfolio beta is equal to what? 0.91. So this part is important. If Nifty raises by 2%, if Nifty raises by 2%, if Nifty raises by 2%, then what? Share value raises by 2.6%. Clear? We are losing money 39 lakhs in Nifty, but we are gaining money 130 lakhs in shares. Overall, 91 lakhs is the benefit on 5000. So what is the percentage change? 91 divided by 5000, 1.82%. So beta is equal to 0.91. Am I clear? Done? Clear? So this question is June 2025 question. Balaji. Hi sir, good afternoon. I completed CMA because of BCCA. Without BCCA cannot be possible. Thank you. Thank you so much, Balaji. Somi Setti. Heart emoji. Thank you. Clear? Okay, so we have covered what? Selling shares proportionately and buying what? Risk-free securities. Buying risk-free securities. Done? Clear? And one more concept we have to cover. What is the concept? One more concept we have to cover. What is the concept? Order of a risk. Selling shares in the order of a risk. So what is the question number? Question number? Additional question number 8. See the additional question number 8. Next, selling shares in order of risk and buying risk-free securities. Question number 8. An investor has the following constituent holdings in his portfolio: security ABC, number of shares, price per share, share beta. Find the market value weighted average beta of his portfolio. We should find out the market value weighted average beta of his portfolio. You know how to find out the market value weighted average beta. Simple. Second part. If the investor wants a target beta of his portfolio at rupees at 0.9, if investor wants a target beta of 0.9, how would he dispose of his portfolios and replace them with government securities if he wants to sell in the order of a risk? How would he dispose of his securities and replace them with government securities? Nothing but what? Here, if he wants to sell in the order of a risk, here he is going to sell the shares in order of risk and buying what? Risk-free securities. Present the revised tabulation of his holding and prove that the target beta has been achieved by your advice. By your advice. So additional question number 8, simple. First, portfolio beta, that is simple. What is the portfolio beta? 1.296. So what is your target beta? 0.9 is the target beta. So that means a target market value into beta is equal to 6,25,000 into 0.9. 5,62,500. Okay. What is your target market value into beta? 5,62,500. Present market value into present. What is the present market value into beta? 8,10,000. So that means, so from 8,10,000, market value into beta must reduce to 5,62,500. So that means it should reduce to 2,47,500. 2,47,500 is the target reduction in market value into beta. How are we going to sell the shares? We are going to sell the shares in order of a risk. So tell me which security is having a high risk. C. What is the C market value into beta? 80,000. Even if you sell entire 80,000, entire C shares, so okay, you cannot reach your target because your target reduction in market value into beta is 2,47,500. So that's why what? Okay, so 80,000. That means entire C limited shares should be sold. What is the balance target? 1,60,000, 67,500. 1,67,500. So what is the next highest beta? 1.4. A. What is the A market value into beta? 2,80,000. So should I sell entire A limited shares? No. A limited shares need not be sold entire shares because A limited shares market value into beta is 2,80,000. But whereas our target is only 1,67,500. So that's why value of a securities 8 should be sold. Value of a securities A to be sold is equal to 1,67,500. That is market value into beta divided by beta. 1,19,643 rupees worth A limited shares should be sold. So that means the revised table is out of 2 lakhs. Out of 2 lakhs, we should sell A limited shares worth 1,19,643. B limited, we are not going to sell. C limited, entire 60,000 rupees worth shares will be sold. And risk-free investment will be 60,000, 60 or 50? 50,000, sorry, 50,000 plus 1,19,643. 1,69,643 rupees will be invested in risk-free securities. And overall investment will remain same, 6,25,000. So then you will get market value into beta 5,62,500 and beta will be 0.9. Clear? So clear? And we have a last part. If he is willing to invest further, means what? Fresh investment. How much investment should he make in government securities to make his beta to 0.9 without selling any share at all? Without selling share at all. Without selling any share at all. Simple. Let the proportion of risky investment is equal to P. Then the proportion of risk-free investment is equal to 1 minus P. And then what? Weighted average. P into existing beta 1.296 plus not into plus 1 minus P into 0 is equal to what? 0.9. So P is equal to what? 0.6944. So the existing investment is equal to what? 6,25,000. For 0.6944, 6,25,000 plus 0.306. What is the amount? 2,75,576. Clear? Am I clear? Okay. So now please pause the video and then what? Practice this question. So this question is for what? Selling the shares in order of a risk. CMA student, we need reduction of rupees 62,500. So here your target is 6,25,000 into 0.9. 5,62,500 is the target market value into beta. Okay. So, but present market value into beta is 8,10,000. So your target reduction in market value into beta is 2,47,500. Okay. So we are going to sell shares in order of risk. First we sell security C. Security C market value into beta is 80,000. And what is the balance target? 1,67,500. Okay. So 1,67,500 is met from what? Security A. So what is the security A beta? 1.4. So value for security A to be sold is equal to 1,19,643. Entire A limited shares need not be sold. So to achieve a target beta 0.9, the overall investment value will remain same. We are not going to make a fresh investment. We are going to change the portfolio composition. We are selling the shares in order of risk and buying risk-free securities. Okay. So what is A limited new market value? 2 lakhs minus 1,19,643. And risk-free C limited entire 50,000 is being sold. So risk-free investment is equal to 1,19,643 plus what? 50,000. So 1,69,643. Clear? So everybody please, is it clear? CMA student, is it clear? So this is a good question. And see the question number 9. In question number 9, there is one special point. So only one special point. So this is a normal question. So this is a question number 9. Taking an appropriate position in index. So there is a special point in this question. Sagar owns a portfolio in 3 stocks as detailed below. The index future is stated at 10250. Assume that index factor is 100. Compute the existing portfolio beta up to 2 decimal. Compute the existing portfolio beta up to 2 decimals. Find out the number of contracts of a stock index futures to be bought or sold in order to decrease the portfolio beta to 0.8. And also increase the portfolio beta to 1.5. One is decrease and the other one is what? Increase. So simple question. First, portfolio beta. So portfolio beta is equal to 1.21. Portfolio beta is equal to what? 1.21. Second part of the question is what? So number of contracts of a stock to be bought or sold in order to decrease beta to 0.8. If you want to decrease beta to 0.8, you should sell the contracts. You should sell the contracts. Number of Nifty contracts to be sold. Portfolio beta. So portfolio into existing beta minus target beta divided by value of one future contract. So 52 crores is the portfolio value into existing beta 1.21 minus target beta 0.8 divided by value of one contract. Contract size 100 into 10,250. So 208 contracts. But here there is one special point. So they are asking this special point for both cases. What will be the proportion of market value of an investment in X? What will be the proportion of market value of investment in X to the value of total investment plus 10% margin on futures? What will be the proportion of market value of investment in X? What is the market value of investment in X? Market value of investment in X is equal to 16 crores divided by total value 52 crores plus 10% margin on futures. 10% margin on futures. So what is the margin amount? How many contracts you are selling? 208. So 208 contracts into 10,250 into 100 into 10%. So 2 crore 13 lakh 20,000 is the margin amount. In denominator, you should take 2 crore 13 lakh 20,000. So 16 crores divided by 52 crores plus 2 crore 13 lakh 20,000. 30% is the proportion of investment in X. So this is the special point in this question. And the second part, increase beta to 1.5. Increase beta to 1.5 means instead of yes, same point it was asked in December 24. In December 24, I think December 24 or June 24, this same point was asked. Okay, increase beta to 1.5. Number of interest contracts to be bought. This time we have to buy. Why we have to buy? Why we have to buy? Simple. Because the reason is here the beta has to be increased, or else you will get negative. Negative means what? You have to buy. So 52 crores into 1.21 existing beta minus target beta 1.5 divided by value of one contract. How many contracts? 147 contracts. So you should find out the margin amount. What is the margin amount? Margin amount is equal to 147 contracts into 10,250 into 100 into 10%. So 15 crores something. So 1 crore 50 lakh 67,500. Again the proportion of X. What is the proportion of X? 16 crores divided by 52 crores plus margin 30%. So this question you have to refer, that's it. This question is not for practice, you have to refer. Okay, you just refer this question for 2 minutes. Next, see the derivatives question number 16. Derivatives question number 16, main question number 16. Commodity futures. So next, derivatives question number 16, commodity futures. Commodity futures. A silver merchant requires in 3 months a time 3000 kg of a silver for making silver articles during a wedding season. A silver merchant requires in 3 months a time 3000 kg of a silver for making silver articles during a wedding season. He expects the price to increase. He is expecting that the price to increase. He wants silver. He is expecting that the price is going to increase. That means he will take a long position. He will take long position in the market. Silver sells at a spot rate of rupees 5,100 per kg. Each silver future contract for 50 kg expiring in 3 months sells at rupees 5,200 per kg. Each silver futures contract is for how many kgs? 50 kgs expiring in 3 months sells at rupees 5,200 per kg. Spot price 5,100 per kg. Understand these terms. Spot price 5,100 means rate applicable for now. If you want to purchase the silver as on today, what is the rate applicable? 5,100. But if you are entering into contract as on today for the purchase of a silver after 3 months, what is the rate applicable? 5,200 per kg. The merchant wants to hedge. Merchant wants to hedge, reduce risk. Hedge half his requirement through futures. Half his requirement through futures. How many kgs he require? He requires 3000 kgs. Half requirement means 1500. Leave the remaining half uncovered. Leave the remaining half uncovered. Explain his position. Explain his position. We have to explain his position. What is the position he has to take? He has to take a long position, and the gains or losses in the spot and futures market. The gains and losses in the spot and futures market. We have to find out what gains and losses in spot and futures market. The number of futures to trade in. The effective price per kg for his entire requirement is after 3 months. Number of futures contracts to trade in, and they are also asking you to find out the effective price per kg for his entire requirement, effective price per kg in after 3 months. So this is a past examination question. This concept was tested frequently in old syllabus. Spot rate is 5250 per kg and future is at 5400 per kg. This is after 3 months. If after 3 months, spot rate is 5250 per kg and future is at rupees 5400 per kg. Spot rate is 5000 per kg and future is at rupees 4900 per kg. So in two scenarios, two cases are given. If after 3 months means on the maturity, spot price is 5250. On the maturity, future price is 5400. Second, what is the second scenario? On the maturity, price is 5000 kgs, 5000 per kg and futures price is 4900 per kg. Okay. So clearly we have to explain the position. So he want silver. He want silver after 3 months. So tell me what position he is going to take. He is going to take a long position. He is going to take a long position. At what rate he is going to take a long position? What is the present future price? 5200 per kg. 5200. So 5200 rupees per kg. So he is going to take a long position at the rate of 5200 per kg. Okay, first case, to close the contract on maturity, he will take a short position at the rate of 5400 because future price on the maturity is 5400. What is the gain? Gain 200 rupees per kg. Clear? What is the gain? 200 rupees per kg. Total how many contracts he is entering into? So he is not going for hedging for entire requirement. He is going to hedge only for half. What is the requirement? 3000 kgs. Half means 1500 kgs and number of contracts 1500 divided by 50. 30 contracts. 30 contracts. So 30 contracts into 50 kgs into per kg. What is the gain? 200. What is the overall gain? 3 lakhs is the overall gain in futures. In futures, the gain is what? 3 lakhs. In futures, gain is 3 lakhs. Clear? Everybody are able to understand? In futures, the gain is 3 lakhs. Okay. So they are asking you to find out what? They are asking you to find out, explain his position. What is the position? Long position. Gain or a loss in spot and future market. Number of futures to trade in. So number of futures to be traded in. What are the contracts? How many contracts? 30 contracts. 30 contracts. And they are asking you to find out gain or a loss and also what? Effective price per kg. So what is the gain in futures contract? 3 lakhs. Now come to the spot market. What about the remaining uncovered 1500 kgs? What is the spot price? 5100. In this question, this is the special part. This is the special part. What is the spot price? 5100 kgs. Instead of entering into futures contract, he can buy 1500 kgs as on today. What is the price? 5100 is the spot price. What is the spot price on maturity? 5250 kgs. So that means he is losing 150 rupees per kg. He is losing 150 rupees per kg. If you see the CA final May 23 answer, that will be different. So that is a different question. So do not get confused. This is the special point in this question. Spot price 5100 as on today. What is the spot price on maturity? 5250. So instead of buying in the spot market, he is buying after 3 months. How much he is going to lose? He is going to spend extra 150 kg for 1500 kg. That means loss is 2,25,000. So the overall net gain is, what is the net gain? 75,000 is the net gain. So this is in futures. This is in the futures and spot market. Next, they are asking you to find out the effective price per kg. Effective price per kg. Effective price per kg is equal to, what is the spot price on maturity? 5250. So I have to buy each cage at the rate of 5250. Total requirement 3000 cages. So 3000 cages into 5250 minus we got a gain of 75,000 divided by 3000 cages. So what is effective price per cage? 5225 rupees is the effective price per cage. Effective price decreased because of gain. What is the gain? 75,000. Clear? We got a gain of 25 rupees per cage. So that's why price decreased by 25 rupees. So this is the first case. Next, the second case. Second case, you will take long position at the rate of 5200. To close the contract, take a short position at the rate of 4900. Loss 300 rupees per cage. So the loss in futures is 4,50,000. What about the gain in spot market? Gain in spot market means if you have purchased this silver in spot, the amount you might have spent is 5,100. But what is the spot rate on maturity? 5,000. Okay. So instead of purchasing as on today, you are purchasing in the future. Due to that, the gain is 100. The gain is 100 rupees per cage. For how many cages? 1500 cages, 1,50,000. So the overall loss is 3 lakhs. In futures, we are losing 4,50,000. So spot, you're getting 1,50,000. Difference between the spot prices, you're getting a benefit 1,50,000. The overall loss 3 lakhs. So effective price per cage is equal to 3000 cages into 5,000 price on the maturity plus you're getting overall loss 3 lakhs divided by 3,000. So the effective price per kg is 5,100 per kg. I have asked you to practice this question during the regular class. So because in this question, this is the special part. This is a special part. So that's why I have asked you to practice this question. Now you do this question. Solve this question. Question number 16. Everybody please go through this question. If you cannot practice, at least try to understand the solution. Okay, fine. Next, see the commodity futures question, CA final question, CA final. CA final. So this question is for practice. This question is for practice. You have to practice this question. You have to practice this question. CA final, May 2023. I think it is 3B. 3B. Mr. V is a commodity trader and specialized himself in trading of rice. He has a 24,000 kg of rice. 24,000 kg of rice. He has. Previous question is different and this question is different. This question is different. Okay. So in this question what? In this question he has 24,000 kg of rice. The following details are available at as on date. Spot price. What is the spot price? 70. 3 months of future price. 68. Expected lower price. Expected lower price after 3 months. He has a 24,000 kg of a rice. He already having a rice. He is expecting that the price will go as low as 64 within next 3 months. Within next 3 months. Contract size 500 kg per contract. You are required to advise Mr. V how to mitigate the risk of fall in price. How to mitigate the risk of fall in price. How to use the futures market. What will be the effective realized price for his sales if after 3 months spot price is rupees 69 per kg and 3 months futures contract price is 72 per kg and 67 per kg. Today on priority you should practice again this question and the previous question. You should know the difference between this question and the previous question. So they are asking you what will be the effective realized price for his sales after 3 months. Spot price is 69 per kg and the 3 months futures contract price is 72 per kg and 67 per kg. Okay. So here it is a commodity futures question. Expecting a lower price after 3 months, 64. He has a 24,000 kgs of rice. How to mitigate the risk of fall in price? How to mitigate? How to reduce the risk of fall in price? Right now he is holding 24,000 kg of rice. In future the price might decrease, yes or no? So tell me how to reduce the risk. Simple. He should take a which position? So how to mitigate the risk? Quantity of a rice to be hedged. How many kgs? 24,000 kgs. Contract size 500 kgs. Number of a contracts 48. Future price 68 per kg. So he has to cover the exposure in the futures market. He has to cover the exposure in the futures market. So how many kgs? 24,000 kgs into 68. 16 lakh 32,000. Nothing but he should enter into a contract as on today. He should short. He should short. Short means sell. He should sell 48 futures contracts at a price of 68 per kg. And on maturity, cancel its position after 3 months by buying futures contract at a prevailing future price. Clear? Second part of the question is how to use the futures market. How to use the futures market. How to use the futures market? He should sell. Mr. V should short 48 futures contracts at a price of rupees 68 per kg and cancel its position. Today he will take short position and on the maturity he will take long position. Clear? Clear? So in last question we require silver. Here already we have a rice. In previous question we took a long position. Here we are taking a short position. Clear? And last part. Two scenarios are given. What will be the effective realized price for his sale if after 3 months, spot price is rupees. What is the spot price? 69 per kg. That means if we sell 1 kg of a rice after 3 months, we are going to receive 69 per kg. And 3 months future price is, two scenarios are given. First scenario 72 per kg. Second scenario. What is the second scenario? 67 per kg. Second scenario 67 per kg. Okay. So tell me how to calculate. Simple. First scenario 72 per kg. Second scenario 67 per kg. Okay. Right now we are taking a short position. So to close the contract, short position contract, we take a long position. So first case we take a long position at the rate of, what is the future price on the maturity? Future price on the maturity is 60. Future price on the maturity. Future price on the maturity is first case 72. Clear? So today we are taking a short position at the rate of 68 and on maturity to close the contract we take a long position at the rate 72. What is the gain? 4 rupees per kg. 4 rupees per kg. So total how many kgs? 24,000 kgs. That means we are getting a gain. Gain or loss? We are buying at the rate of sorry, loss. We are buying at 72 and selling at what? 68. So loss 4 rupees, and for how many cages? 24,000 cages. So overall loss is 96,000. 96,000. Second case. Second case, we are selling at 68, buying at 67. So gain 1 rupee per cage. Total how many cages? 24,000 cages. Clear? Am I clear? So okay. So case 1, loss on futures 96,000. Case 2, gain on futures 24,000. And next, so we are going to sell 24,000 cages, each cage at 69. And we are going to receive what? 16,56,000. So first case, what is the overall effective realization? 16,56,000 minus 16,56,000 minus 96,000, 15,60,000. So effective selling price is equal to 65 rupees per cage. Second case, 16,56,000 plus we got a gain of 24,000. So what is the effective selling price? 70 rupees per cage. Clear? Okay. So now pause the video and please solve this question. Vinila, you have once explained this question. Once explained this question means you are asking me to explain again or what? So tell me if you want to explain me again, I will explain. Everybody, is it clear? Online students? Question, huh? So this is the question. Please try this question. First part, how to mitigate the risk of a fall in price. Simple, we use the futures contract. Please try this question. Done. Now let us come to the next concept, options. Options. In options, we have two parts. One is basics and second is option valuation. Option valuation. So examination point of view, for us, basics and option valuation, only two models are important mainly. Risk neutralization and binomial model. These two are frequently asked concepts, and you can focus on what? Only basics and risk neutralization and binomial if time does not permit. Okay. So what is option? Option is a right. Futures is what? Futures is an obligation. Futures is an obligation. Option is a right. So options can be two types of options: call option, put option. So in futures we have two positions, right? Long position, short position. Long position means buy position, short position means sell position. Likewise in options we have two options: call option, put option. Call option means right to buy, put option means right to sell. Okay. An option buyer is called as holder, and option seller is called as writer. A person who is selling an option is called as writer, and a person who is purchasing an option is called as holder. Holder pay premium to the writer, and premium is non-refundable. Premium is an expense. Premium is an expense. But whereas initial margin in futures is what? Security deposit. Security deposit. Premium is an expense. Premium is an expense. Okay. It is non-refundable. It is non-refundable. For holder it is a right, but for writer it is an obligation. Call option means right to buy. Put option means right to sell. Call option means right to buy. Put option means right to sell. Okay. So in option valuation, we have a put call parity equation concept, minimum value of a call and also minimum value of a put. In risk neutralization, we have a binomial, two period binomial, Black-Scholes and risk neutralization. So option, call option, put option. So call option we exercise if FSP is greater than X, future spot price is greater than X, the price on the maturity is greater than X. X means a strike price or a exercise price. Break even FSP is equal to X plus premium. X means exercise price plus premium. Holder will get unlimited profit and limited loss, but writer will get limited profit, unlimited loss. Okay. Call option means right to buy. So call option is exercised if FSP is greater than X. For suppose if FSP is 500 but X is equal to 300. X 300 means I have a right to buy one share at the rate of 300, but whereas the price on the maturity is 500. Will I exercise the call option or not? Exercise price 300. Price on the maturity 500. Will I exercise the option or not? Yes, I will exercise the option. And the benefit I'm going to get is 200 rupees. 200 rupees. So call option is exercised if FSP is greater than X. Okay, holder will get unlimited profit and limited loss. Writer will get limited profit and what? Unlimited loss. Because the price might increase to what? 10,000, 20,000 also. So that's why. The next put option. Put option is exercised if FSP is less than X. Future spot price is less than X. Okay. So put option means right to sell. For suppose I have a right to sell at 300. I have a right to sell at 300. For in market the price on the maturity is 500. Will I exercise the put option? No, I will not exercise the put option because in market price is 500. I have a right to sell at 300. It is better to sell in the market. But whereas if the market on the price on the maturity is only 200 rupees, only 200, will I sell it or not? Yes, I will exercise the put option and I will sell at 300. So that means put option is exercised if FSP is less than X. Break even future spot price is equal to X minus premium. Okay. So in case of a put option, holder will get limited loss. In all the cases, holder will get what? Limited loss, because maximum he will be losing what? Premium. Holder will be losing only premium. Clear? So are you able to understand what is call option and put option? If you know the call option and put option basics, you can answer what? Question number 8, 9 and 10. So main question number 10. So this is asked in June 25. Main question number 10. This is June 2025 question. Same question it was asked in June 2025. Basic question. This question is enough. So this question, if you practice this question, this is enough. Okay. So question number 10. You as an investor had purchased a 4-month call option on equity shares of X Limited of rupees 10, of which current market price is 132, exercise price is 150. You expect the price to range between 120 to 190. The expected share price of X Limited and related probability is given below. Expected price 120, 140, 160, 180, 190. Probability 0.05, 0.20, 0.50, 0.10, 0.15. Compute the following. Expected share price at the end of 4 months. Value of a call option at the end of 4 months if the exercise price prevails. In case the option is held to its maturity, what will be the expected value of a call option? What's the first one? They are asking you to find out the expected share price at the end of a 4 months. How can we get expected share price at the end of 4 months? By doing a weighted average. So 120 into 0.05 plus 140 into 0.2 plus 160 into 0.5 plus 180 into 0.1 plus 190 into 0.15. So 160.5 is the answer. Second, value of a call option at the end of 4 months if the exercise price prevails. Exercise price prevails means what? If on the maturity the price is equal to exercise price. What is exercise price? 150. Exercise price. You have a right to buy one share at the rate of 150, and if on the maturity the price is also 150, then what is the value of call option? Value of a call option is equal to 0. Derivative is an instrument the value of which is derived from the value of an underlying asset. Call option is a derivative. Call option value depends upon the value of an underlying asset. What is the value of underlying asset on the maturity? In the present case, 150. Okay, exercise price is also 150. So tell me, what is the value of a call option at the end of a 4 months? 0. Next, in case the option is held to its maturity. In case the option is held to its maturity. For suppose up to its maturity, okay, you are holding the option. What will be the expected value of a call option? What will be the expected value of a call option? So this is simple, but I have seen one certified copy. Student has committed a mistake here. Simple expected value of a call if it is held up to its maturity. So we have a 5 possible prices. On the maturity, the price can be what? 120, 140, 160, 180, 190. So I have a right to buy at the rate of 150. So tell me first action. So I have a right to buy at 150, but whereas the price on the maturity is 120. So tell me, am I going to purchase it or not? I'm going to exercise or not? No, lapse. Second case, lapse. Third case, exercise. Fourth, exercise. Last case, exercise. So what is the value of a call? First case, 0. Second case, 0. Third case, 0. Next, 10 rupees. Because I'm exercising the right to buy at 150 when the market price is 160. I'm getting a benefit of 10. So the value of a call option is equal to 10. And next value of a call option 30. And next what? 40. So probability is given. Probability. Okay. Probability. So 5% chance that there is a 5% chance that value of a call can be 0. 20% chance that value of a call can be 0. 50% chance that value of a call can be 10. 10% chance that value of a call can be 30. And 15% chance that value of a call can be 40. Clear? By doing weighted average, we get expected value of a call. What is the expected value of a call? 14 rupees is the expected value of a call. Clear? So this is the basic question to understand the concept of a call option. And also let us see the 9th question to understand the concept of put option as well. 9th question. The share of a VCC Limited is quoted at 210. So what is the spot price as on today? 210. A 3-month call option is available at a premium of rupees 6 per share, and 3 months put option is available at a premium of rupees 5 per share. Ascertain the net payoff to the option holder of a call option and put option. Ascertain the net payoff to the option holder of a call option and put option. The strike price in both the cases is rupees 220, and the share price on the exercise day is rupees 200, 210, 220, 230, 240. Also indicate the price range at which the call and the put option may be gainfully exercised. Gainfully exercised. So what is the strike price in both the cases? 220. Call option and put option 220. So 5 scenarios are given. So first let us see the call option. So 220, right to buy at 220. So what is the first possibility? 200. So lapse. Second case what? Lapse. Third case, lapse. So fourth case, exercise. I have a right to buy at 220, but price on maturity is 230. Exercise. Next case, exercise. I have a right to buy at 220, but the price on the maturity is 240. Exercise. So value of a call, fourth case 10, fifth case 20. Net payoff means the benefit minus expense. What is the benefit? First case, fourth case 10, but we have already paid premium 6. That means net benefit is only 4 rupees. But first case, we are not getting benefit, any benefit, 0 benefit, but expense is 6 rupees. Premium is an expense, non-refundable. 6 rupees loss. Second case, 6 rupees loss. Third case, 6 rupees loss. Last case, 14 rupees benefit. 14 rupees benefit. Clear? Done. Put option. Put option means what? Right to sell. I have a right to sell at 220. First case, what is the price on maturity? 200. If I sell in the market, I will get only 200. But if I exercise a put option, I will get 220. So tell me what is the value of a put? Value of a put is equal to 20. Value of a put is equal to 20. What about the second case? 210. Strike price 220. If I sell in the market, I will get 210. But whereas the strike price 220. So benefit 10. In last three cases 0. I will allow the put option to lapse. I will allow the put option to lapse. So net profit 15 first case, second case 5, last case, I mean last three cases 5 rupees negative. Is it clear everybody? Please respond, online students. Clear? Okay. So last attempt they have asked question number 10, June 2025. Now let us move on to the next concept. What is the next concept? Minimum value of a call, minimum value of a put, and put call parity equation. Put call parity equation. Put call parity equation. Parity means what? Equal. Parity means equal. Parity means equal. Put call parity equation. So value of a call plus present value of X is equal to value of a put plus value of a share. To remember this formula, simple logic, value of a call means right to buy. In future we are going to buy the share, right? For that we need money. So deposit present value of X, deposit present value of a X. So that's why on left hand side, value of a call plus present value of a X. How do we get present value of X? X into e power minus TRF. X into e power minus TRF. Right hand side, value of a put. Put means right to sell. So in future we are going to sell the share. So that's why what? You have to hold share as well. Okay. So value of a call plus present value of X is equal to value of a put plus value of a share. Clear? So value of a share is nothing but what? Spot price. Price as on today. So put call parity equation is generally used to find out what? Missing figures. Is used to find out missing figures. Okay. Next, minimum value of a call. Minimum value of a call. So these are less important from examination point of view. Put call parity equation, they might ask MCQ. Multiple choice question. Multiple choice question. So they might give value of a call, X strike price, and spot price will be given, and they will ask you to find out what value of a put. So there are 4 components in this equation. They will give 3 components and they will ask you to what? 3 variables. They will give 3 variables and they will ask you to what? Find out 4th variable. So minimum value of a call. Minimum value of a call is equal to. So in previous questions we have calculated value of a call and value of a put. But those are value of a call or a put on maturity. On maturity. But it is present minimum value of a call, present value. The formula which is given on the screen is present value. So what is the present minimum value of a call? Spot price minus X into e power minus TRF. So we have seen the logic in regular class. Spot price minus X into e power minus TRF. What is this X into e power minus TRF? To explain this formula, the logic is call option means right to buy. So in future you are going to sell the share. Sorry, buy the share. In future you are going to buy the share. When you buy the share, you will incur outflow. We don't know the exact outflow, but the maximum outflow will be what? X. Maximum outflow will be X. I have a right to buy at X. So maximum I am going to spend what? X. But if in the market the price on the maturity is less than X, I will buy in the market. So that's why my outflow can be what? Less than X. So this X is maximum outflow. I'm bringing that outflow to the present value. X into e power minus TRF. In future anyway I'm going to buy the share, right? So today I will sell the share, short selling. I will borrow the share from the broker and I will sell the share in the market. So spot price is inflow. Spot price is inflow. So it is called as minimum value of a call. It is not an exact value of a call. Exact value of a call we are going to find out using the option valuation models. Option valuation models. Okay. So spot price minus X into e power minus TRF is what? Minimum value of a call. Why it is called as minimum value of a call? Because inflow minus, we are taking maximum outflow, not the exact outflow. So that's why. Put option means right to sell. In future we are going to sell the share. We are going to sell the share. Put option means right to sell at X. Right to sell at X. minimum I will get X, minimum I will get X, but I have a right to buy, I right to sell at X. If market price on the maturity is greater than X, then what I will do? I will sell in the market. I will sell in the market. So here I am taking a minimum inflow. Minimum inflow. So that is X into e power minus TRF minus what? Spot price. Why spot price? Because in future I have to sell the share. That means today I have to buy the share. On purchase of share, I will incur outflow. So you can, I mean, just remember the formula. So logic is not important. So minimum value of a call, spot price minus X into e power minus TRF. Minimum value of a put, X into e power minus TRF minus spot price. Okay, so this is less important. Less important for Black-Scholes model. So to remember the Black-Scholes formula. So this is important. Minimum value of a call and what? Minimum value of a put. Risk neutralization model. Option valuation models. We have a 4 option valuation models. Risk neutralization model, binomial model, and what? 2-period binomial model. 2-period binomial model. And also what? Black-Scholes model. In these 4 models, the important models are risk neutralization, binomial. These 2 are very important. Risk neutralization is very simple. Let us see the question. Risk neutralization, question number 12. So this is a practice question. So they might ask this concept as an MCQ also, risk neutralization model. Option valuation models, there are 4 models: risk neutralization, binomial, 2-period binomial, and Black-Scholes model. Risk neutralization is simple model. The current market price of an equity share of P Limited is 420. Within a period of 3 months, the maximum and minimum price of it is expected to be rupees 500 and 400 respectively. If the risk-free rate of interest be 8% per annum, what should be the value of a 3-month call option under the risk neutral method at a strike rate of rupees 450, given e power 0.02 is equal to 1.0202. Simple method, risk neutralization. This is very, very important because last time they have asked basic question from options. So this time what they might ask, risk neutralization or binomial. Risk neutralization or binomial. Risk neutralization, very simple. So in a risk neutral world, investors will expect risk-free rate of a return. Investors will be expecting what? Risk-free rate of a return. Risk-free rate of a return. So you have to practice this question. Spot price. What is the spot price? 420. What is the maximum price? In next how many months? 3 months. In next 3 months, price may increase to 500 or price may decrease to 400. Risk-free rate 8% per annum. Strike price rupees 450. Strike price rupees 450. Risk-free rate 8% per annum. Okay. So tell me, here generally in previous question, options basic question, probability is given. 5 of future prices are given and probability is also given. Generally probability is assigned. But under risk neutralization method, we calculate the probability. Risk neutralization, binomial model, 2-period binomial, all these 3 models are binomial models only. Bi means 2. In all the 3 models, 2 possible prices will be given. 2 possible prices. Only Black-Scholes model is not a binomial model. But to differentiate, we are giving the name risk neutralization method. So the risk neutralization method assumption is investor will expect a risk-free rate of a return in a risk-neutral world. Because risk is neutralized, investor will expect a risk-free rate. So what is the spot price as on today? 420 is the spot price as on today. What is the risk-free rate? 8% per annum. 8% per annum. Okay. So as on today the price is 420. So this 420 rupees price might increase to 420 into, so might increase to 500 and what? 400, no doubt. But the expected spot price expected spot price will be what? 420 into e power 0.08 into 3 by 12. Why 420 into e power 0.08 into 3 by 12? Because investors expect what? Risk-free rate of a return. So the expected spot price after 3 months will be 420 into e power 0.08 into 3 by 12. So everybody following me? Abhimati? Are getting my point? So here, so be careful, we are not finding out the proportion. We are finding out the probability. Many times we assume let the proportion be P. But here let the probability of upper FSP is equal to, let the probability of upper FSP is equal to P. Upper FSP is equal to what? P. Then probability of downward FSP is equal to, what is the probability of downward FSP? 1 minus P. 1 minus P. So the equation is P into 500 plus 1 minus P into 400 must be equal to what? Expected spot price. Okay, in previous question we have a calculated expected spot price by doing weighted average. Weights are given in the question, but in risk neutralization method, under risk neutralization method, we are going to find out what? Weights. We're going to find out what? Weights. So P into 500 plus 1 minus P into 400 is equal to 420 into e power 0.08 into 3 by 12. So the probability after solving, you will get probability 0.2848. Now the value of a call option, simple. Strike price is 450. Strike price is 450. What is the meaning of this 450? I have a right to buy one share at the rate of 450. In next 3 months, price may increase to 500 or decrease to 400. If a price increases to 500, so I will exercise the call option and the benefit I am going to get is 50 rupees. What about if price decreases to 400? If a price decreases to 400, then what? Okay, if a price decreases to 400, then I will allow the call option to lapse. Value of a call is equal to 0. That means at the end of a 3 months, value of a call can be 50 or 0. What is the probability of, so value of a call 50, 0.2848. There is 28.48% chance that value of a call on the maturity will be 50. Okay, clear? What is the expected value? 0.2848 into 50. 0.2848 into 50. You will get 14.24. This 14.24 is the expected value of a call at the end of 3 months. Expected value of a call at the end of 3 months. Clear? But I should bring it to the present value. To bring it to the present value, e power 0.08, 14.24 divided by e power 0.08 into 3 by 12. Nothing but e power 0.02. So e power 0.02 value is given 1.0202. So the answer is 13.96. 13.96 is the answer. What is this 13.96? Present value of a call. Risk neutralization method is simple. There is an alternative method also. I am not explaining that alternative method. So this is simple method. We have to find out what probability of upper FSP and probability of downward FSP. Clear? And next, how this put call parity equation is used. Put call parity equation is used to find out what? Missing figures. Missing figures. So for example, here value of a call. What is the value of a call? 13.96. 13.96. Okay. So put call parity equation. Value of a call plus x into e power minus TRF is equal to value of a put plus value of a share. Value of a share. So value of a call 13.96 plus 450 is the strike price. We should bring it to the present value. 450 divided by 1.0202 is equal to value of a put plus, we know the spot price. What is the spot price? 420. So value of a put is equal to 35.049. Clear? So this value of a put is not asked in the question. But for MCQs they will give value of a call. Nothing but call premium will be given. Call premium will be given. And next what? strike price will be given, and also what spot price will be given, and they will ask you to find out what value of a put. Okay, or they might give value of a put and ask you to find out what value of a call. Clear? So this is a risk neutralization model. Risk neutralization model. Am I clear? And now let us come to the next one, binomial model. Binomial model. Next question, question number 13. It is also a frequently asked concept. Frequently asked question. Question number 13. So this is a frequently asked question. Question number 13. Question number 13. Mr. Dayal is interested in purchasing equity shares of ABC Limited. So this is a binomial method which are currently selling at rupees 600 each. He expects that price of a share may go up to rupees 780 or may go down to 480 in 3 months. The chances of occurring such variations are 60% and 40% respectively. A call option on the shares of ABC Limited can be exercised at the end of 3 months with a strike price of rupees 630. What combination of a share and option should Mr. Dayal select if he wants a perfect hedge? What should be the value of option today? The risk-free rate is 10% per annum. What is the expected rate of a return on the option? What is the expected rate of a return on the option? So what is the spot price as on today? What is the spot price? 600. He expects that the price may go up to 780 or decrease to 480. This is also a binomial model. Two possible prices are given. Price may move up to 780, may go down to 480. The chances of occurring such variations are 60% and 40% respectively. Be careful with these percentages. Chances of such variations are given 60% and 40%. This is the special point in this question for third part. 60-40. Call option on the shares of ABC Limited can be exercised at the end of 3 months with a strike price of rupees 630. What combination of a share and option Mr. Dayal select if he wants a perfect hedge? What combination of a share and option should Mr. Dayal select if he wants a perfect hedge? For suppose if he wants a perfect hedge, what combination of a share and option? Nowhere they have mentioned. It is a binomial model. So binomial model is simple. First, in binomial model, we should assume a risk-free portfolio. Risk-free portfolio. What is the risk-free portfolio? So we have to assume a risk-free portfolio. Risk-free portfolio. Write a call option. We have to find out the value of a call option. So that's why write a call option. Write a call option means sell a call option. If you are selling a call option, you have a risk. You have a risk because in future the price might increase and holder of a call option may exercise the call option and you are under obligation to sell a share at X. So that's why you are under a risk. So that's why write a call option and also what? Hold delta shares. Hold delta shares. They might ask you MCQ. Delta. Delta. How do we calculate delta? Delta is equal to change in value of option divided by change in value of a share. Change in value of a option divided by change in value of a share. So change in value of a option. Change in value of a option. So what is the change in value of option? So what is the strike price? 630. Price may move up to 780. If a price move up to 780, holder will exercise the call option. And what is the value of a call option? 150. If a price decreases to 480, then what is the value of a call? 0. So change in value of option 150 minus 0 divided by change in value of a share 780 minus 480. So 300. 150 divided by 300. So answer is 0.5. 0.5 shares is the answer. Clear? Done. So first, in binomial model, we should assume a risk-free portfolio. What is a risk-free portfolio? Write a call option, hold delta shares. Why we should hold only delta shares? Why we should hold only 0.5 shares? Because the reason is to handle the risk arising from one call option, To handle the risk arising from writing a one call option, we need not hold one share, because if you see the calculation, call option is changing only by 150, but the share value is changing by 300. So to handle the change of 150, we don't require 300. So that's why we need to hold only 0.5 shares. Clear? So delta shares 0.5 shares. Write a call option, hold delta shares. So next, calculation of value of a call. So tell me, FSP can be what, 780 or 480? Value of a call, sorry, strike price. What is the strike price? 630 and 630. So tell me, what is action of a holder? First case, if FSP is 780, holder is going to what? Exercise the option. Holder is going to exercise the option. Second case, lapse. So value of a call, what is the value of a call? Minus 150. Why it is minus 150? Because we are not holding the call option, we are writing a call option. If you are writing a call option, you are not going to get 150. You are losing 150. You are losing 150. So that's why I'm taking 150 in brackets. So in portfolio, I have two components. One is writing a call option, and next what? Holding delta shares. So I have a 0.5 share. This 0.5 share value will be what? 0.5 into 780. 0.5 into what? 780. So 390. 390. So the overall portfolio value will be 390 minus 150. 240. 390 minus 150, 240. Clear? Done. What about second case? Second case, value of a call 0. But what about the value of a share? Value of a share is equal to 0.5 into 480, 240. In either of the case, if you see, the value of a portfolio is same, 240. What does it mean? Irrespective of a future spot price, value of a portfolio will remain same. That's why in the beginning itself we have mentioned assume a risk-free portfolio. Assume a risk-free portfolio. Okay, so that 240 is what? Value of a portfolio at the end of 3 months. I should bring it to the present value. So 240 divided by e power 0.1 into 3 by 12. If I bring it to the present value, I am getting 234.07. What is this 234.07? This is the value of a portfolio as on today. As on today, the value of a portfolio. My portfolio is containing what? Call option and what? Share. 0.5 share. If you remove the share value from this portfolio value, the remaining balance will be what? Remaining balance will be value of a call. So tell me, as on today, what is the share value? What is the share value as on today? 600. I have only 0.5 share. 0.5 share value is equal to 300. So 300 minus value of a portfolio, 234.07. So value of a call is equal to 65.93. You will get negative. You will get negative. Yes, you will get negative. Why you will get negative? Because if you purchase the share, your outflow is 300. If you sell the call option, you will receive 65.93 inflow. So 300 minus 65.93, you will get value of a portfolio 234.07. So binomial is simple. In the beginning, you might feel confused, but simple. Binomial model. So first part of the question is, what combination of a share and option should Mr. Dayal select if he wants a perfect hedge? A perfect hedge means risk-free. Risk-free. If you want risk-free, what combination of share and option? Share and option. That is binomial model. Write a call option, hold delta shares. Delta shares is equal to change in value of option divided by change in value of a share. So that is 0.5. Clear? Next, what we are doing here? We are finding out the value of a portfolio on maturity. Value of a portfolio on maturity. For suppose if price increases 780, value of a call is equal to minus 150. Value of a share 390. 390 minus 150, 240. If a price decreases to 480, then value of a call 0 because holder will not exercise the call option. Value of a share 240 and value of a portfolio is equal to 240. Okay, so in either of the case, value of a portfolio is equal to 240. So bring the 240 to present value. You will get 234.07. From this 234.07, reduce minus what? Value of a share. What is the value of a share as on today? 600 into 0.5, 300. So the balance figure is value of a call. Clear? And in this question, third part is little different. I mean, it is not conceptual. 60% and 40% chances of variation is given. Chances of variation 60 and 40. 60 and 40. That means 60% chance that price may move up to 780. 40% chance that price may go down to 480. So that means what is the expected value of a call? Expected value of a call. If a price increases, value of a call 150. What is the chances? What is the percentage of occurrence? 60%. So 150 into 60% plus 0 into 40%. So 90 rupees is the expected value of a call. Clear? So expected rate of a return. This is the special point because this is not conceptual. You have to remember this point. Expected rate of a return. How do we find out the expected rate of a return? Simple. What is the theoretical value of a call as on today? 65.923. So that is considered as an investment as on today. 65.923. And what is the expected value of a call? 90. So if you buy call option at 65.923, you will be receiving a benefit of difference. It is similar to P1 minus P0 divided by P0. P1 minus P0 divided by P0. Here the investment is 65.923 and investment value will increase to 90. And what is the expected rate of a return? 36.523%. 36.523%. Am I clear? Done. So this is binomial model. So please pause the video and try to understand binomial model. If you know the binomial model, practice, solve this question within the time. So this is most frequently asked concept question, same question without changing the numbers. This question was asked. Everybody, is it clear? Now come to the question number 14. Question number 14. Two-period binomial model. Two-period binomial model is similar to risk neutralization model. Two-period binomial model. It was not tested in examination till date. Till date. It was not tested, okay? So it is not that important from examination point of view, but why to take chance? So that's why we are discussing this concept. Consider a 2-year American call option. 2-year American call option. Call option can be an American call option or a European call option. European option means it has to be exercised only on maturity. American option means it can be exercised on or before the maturity. So 2-year American call option with a strike price of rupees 50 on a stock, the current price of which is also rupees 50. Strike price 50, current stock price 50. Assume that there are 2 time periods. Assume that there are 2 time periods. So because so we should know that this is a 2-period binomial model. So assume that there are 2 time periods of 1 year. Because of this sentence, we are getting to know that this is a 2-period binomial model. 2 time periods of 1 year, and in each year the stock price can move up or down by equal percentage of 20%. In each year the stock price can move up or down equally by 20%. The risk-free interest rate is 6%. Using a binomial option model. Using binomial option model means this is 2-period binomial, not the normal binomial. Write a call option, hold a delta shares, not that method. Using a binomial option method, calculate the probability of price moving up and down And also draw a two-step binomial tree showing a price and a payoff at each node. So calculate the probability of price moving up and down. Calculate the price moving up and down. Probability. So risk neutralization, you know the risk neutralization. How we find out the probability? P into upper FSP plus 1 minus P into downward FSP is equal to spot price into e power TRF. So P, let the probability of upper FSP is equal to P, downward FSP is equal to 1 minus P. Yes or no? Here, consider two time periods of 1 year. In each year, the stock price can move up or down by equal percentage of 20%. In each year, stock price may move up or down by 20%. So the risk-free interest rate is 6%. Using binomial option model, calculate the probability of price moving up and down. Also draw two-period binomial tree showing prices and payoffs at each node. So let us see this question. First we should find out what? Probability. So tell me, within a year price may move up to what? 60, or may decrease to what? 40. So that means upper FSP is equal to 60. Upper FSP is equal to 60. Downward FSP is equal to 40. Let the probability of upper FSP is equal to P. Downward FSP is equal to 1 minus P. Okay. So P into 60 plus 1 minus P into 40. So this 60 and 40 are the prices at the end of the first year. So P into 60 plus 1 minus P into 40 is equal to 50 into what? E power 0.06. Risk-free rate is given, e power 0.06. At least you should learn how to find out the probability for two-period binomial. At least you can attempt half. So what is the probability? 0.6545. So probability of upper FSP is equal to 0.6545. Downward FSP is equal to 0.3455. Same like risk neutralization model. So probability of price moving up 0.6545, price moving down 0.3455. Clear? Is it clear now? Now come to the binomial tree. So what is the spot price as on today? 50. You will find similar kind of a tree in evaluation of risky proposal, decision tree. So spot price 50. So this 50 may increase to 60 or decrease to 40 in 1 year. In next one year, 50 may increase to 60 or decrease to what? 40. And in second year, this 60 may increase to 72 or decrease to 48, because in each year price may increase or decrease by 20%. Okay, 40 may increase to 48 or decrease to 32. So total there are 4 paths, four possibilities. So as on today, 50 price may increase to 60 and increase to 72. Increase to 72. That is first possibility. Second possibility, 50 may increase to 60 and decrease to 48. Third possibility, 50 may decrease to 40 and increase to 48 by the end of second year. And next, 50 may decrease to 40 and again decrease to what? 32. So total 4 possibilities. Clear? So now what is the strike price? Strike price 50. 50 is the strike price. Call option means I have a right to buy at the rate of 50. I have a right to buy at the rate of 50. I have a right to buy at the rate of 50 means what? Okay. So first case, I will exercise the call option and the value of a call will be 22. Value of a call will be what? 22. Yes or no? Am I clear? Okay. In all the 3 cases, in all other 3 cases, what? 0. Because market price is 48. Market price is 48. I have a right to buy at the rate of 50. So what I will do? I will allow the call option to lapse. Now see this joint probability. What is this joint probability? So probability of price moving up is 0.6545. Probability of price moving down is 0.3455. Yes or no? 50 to 60, what is the probability? 0.6545. 50 to 40, what is the probability? 0.3455. And again 60 to 72. 60 to 72, what is the probability? Again 60 to 72, what is the probability? Price moving up. Probability of price moving up 0.6545. Probability of price moving down 0.3455. And next 40 may increase to what? 40 may increase to 0.6545. Okay. And 40 may decrease to what? 32, 0.3455. So what is this joint probability? Joint probability of a path 1. Path 1. What is path 1? 50 to 60, 60 to 70, 72. For 50 to 62, sorry, for 50 to 60, what is the probability? 0.6545. And again for 60 to 72, what is the probability? 0.6545. What is the overall probability? 0.6545 into 0.6545, that is 0.4284. Nothing but 42.84% chance that price may increase from 50 to 72. So that is the joint probability. Okay. Next path is what? 50 60 50 48. 50 to 60, 60 to 48. What is the possibility of that path? 0.6545 into 0.3455. So 0.226. Third path probability 0.3455 into 0.6545. 0.6545. So 0.226. And next path 0.3455 into 0.3455. So what is the joint probability? 0.119 is the joint probability. Clear? So I have just drawn a binomial tree now. So the actual question is, they are asking you to find out what value of a call at each node. If it is direct calculation, simple. If it is direct calculation, simple calculation. Because in only in one case, you are exercising the option. 22 rupees is the value of a call. That if a price increases to what? 72. What is the probability of price increasing to 72? 0.4284. So 22 into 0.4284 divided by e power. What is the rate? Rate of interest? 0.06 into 2. What is 2? 2 years. 2 years. Simple calculation. Value of a call option as on today is equal to 22 into 0.4284 divided by e power 0.06 into 2. We should bring it to the present value. Then you will get 8.36. You will get 8.36. Clear? But here in this question, they asked you to find out what? They have asked you to find out what? Value of a call at each node. Value of a call at each node. At this node, how to find out the value of a call? 22 into, first we should take 22 into 0.6545. 22 into 0.6545 divided by what? E power 0.06. Understand the calculation. 22 into 0.4284 plus 0 into 0.226 plus 0 into 0.226 plus 0 into 0.119. 9.4248 is the expected value of a call on the maturity. Expected value of a call on the maturity. Okay. So this 8.36 is what? Present value of a call as on today. But they have asked you to find out what value of a call at each node. Node, N-O-D, node. Node. Each node means what? So at each node means we have to find out at each branch. So total, we should consider this as 3 risk neutralization questions. Okay. But examination point of view, you should learn at least what, how to find out the present value of a call. You just learn how to find out the present value of a call. Right now at each node is not required. At least learn what? Present value of a call. So present value of a call is simple. 22 into joint probability 0.4284. That is the expected value of a call on the maturity. Bring it to the present value. That's it. Clear? Are able to understand this 2-period binomial model? Simple. 50 may increase to 60 or decrease to 40. 60 then may increase to 72 or decrease to 48. 40 may increase to 48 or decrease to 32. What is the probability of upper FSP? That we calculated using what? Risk neutralization method. Same. 0.6545. And next, the probability of downward FSP. 0.3455. Am I clear? Done. Is it clear? Now come to the last one, Black-Scholes model. Black-Scholes. At least you try. Do not ignore. At least if you remember this formula, that is D1 and D2 formula. D1 and D2 formula. At least what you will be able to attempt. And if Black-Scholes model question appears in examination, it is easy to score 7 marks. In June 2012, this question was asked last time. Okay. But if they want to make you cry, then they might give what? Black-Scholes model. So that's why we should not take chance. At least what? Remember D1, D2 formula. Question number 15. The shares of a X Pro Limited are currently priced at 408. Currently priced at what? 408. Call option exercisable in 3 months time has an average exercise rate of 400. Risk-free interest rate is 5% per annum. Standard deviation of a shares is 22%. Standard deviation is given means we should use Black-Scholes model. Okay, and 2 possible prices will not be given in the question. So current price is 408. Call option is exercisable in 3 months time and an exercise rate of 400. Risk-free rate 5% per annum. Standard deviation 22%. The company is going to declare a dividend of 10 rupees. Company is going to declare a dividend of 10 rupees and it is expected to be paid in 2 months time. Okay. 2 months time. Required. Determine the value of a 3 months call option. Determine the value of a 3 months call option on the share of E Limited based on Black-Scholes model. Based on Black-Scholes model, we should find out what? Value of a 3 months call option. Simple. So first we have taken the information: spot price, strike price, risk-free rate, standard deviation, dividend, and what? Time. Time we should take in years. How many years? 0.25 years. 3 months means 0.25 years. Okay. All the information is given. First point you have to remember is when dividend is given, we should find out the adjusted spot price. Adjusted spot price. Adjusted spot price means spot price minus present value of a dividend. Nothing but we should take a pure equity share price, X dividend price. We should exclude the dividend. We should exclude the dividend. First step. First step, we should find out what? Adjusted spot price. Adjusted spot price is equal to spot price minus present value of a dividend. What is the spot price? 408. Dividend 10 rupees, which is receivable in how many months? 2 months. So 408 minus 10 into e power minus 2 by 12. Why minus 2 by 12? We are bringing it to present value. So e power minus 2 by 12 into 0.05. So 408 minus 10 into e power minus 0.00833. So e power minus 0.00833 value is already given in the question. Already given in the question. Okay, so we should multiply 10 with 0.9917. So what is adjusted spot price? 398.083 is the adjusted spot price. 398.083 is the adjusted spot price. Clear? So this is the adjusted spot price. First step is to find out adjusted spot price. Now you have to remember this formula, D1 formula. This you have to by heart. This you have to by heart, no other option. Step 1, D1. D1 is equal to natural log of S by X. Ln means natural log. D1 is equal to natural log of S by X. So before entering exam hall, go through this formula. D1 is equal to natural log of S by X. S means spot price, adjusted spot price. X means strike price. Natural log of S by X plus R means rate of interest plus sigma square variance divided by 2 into T divided by sigma into square root of a T. Sigma into square root of a T. Natural log of adjusted spot price already calculated. What is adjusted spot price? 398 divided by strike price. What is the strike price? 400 plus R 0.05 plus standard deviation 22% means 0.22 square divided by 2 into 0.25 divided by 0.22 into square root of 0.25. Okay. So natural log value is also given. Natural log value, it is minus natural log of 0.99521. Natural log of 0.99521 is equal to minus 0.00480. In question bank, minus symbol is missing. Minus 0.00480 plus 0.0185 is equal to 0.125. 0.1245. So this is the step 1. Simple one. You should know how to find out D1 and D2. Remaining are all simple. First you should know how to find out what D1 and next D2. D1 and D2. So D1, clear? D1 natural log of S by X plus R plus sigma square divided by 2 into T divided by sigma into square root of a T. Next, D2 is equal to, next D2 calculation. D2 is equal to D2 is equal to, not step 2 is equal to, D2 is equal to D1 minus sigma into square root of a T. D1 minus sigma into square root of a T. So D1 is already calculated, 0.1241 minus sigma into square root of T, that is also already calculated. So step 2, D2 is equal to what? 0.015. So first step is to find out D1 and D2. Natural log will be given in the question. So first we calculated adjusted spot price minus present value of a dividend. Next what? We calculated D1 and next what? D2. Now we have to take ND1 values and ND2 values, normal distribution table values. So these values will also be given in the question itself. N of 0.125 is already given. N of 0.125, 0.5498. N of 0.015 is also given, 0.5060. Step 3 is to get ND1 value and ND2 value. ND1 value and ND2 value. ND1 value and ND2 value. Clear? Now, value of a call option. Value of a call option. What is the minimum value of a call option formula? So we discussed minimum value of a call. Minimum value of a call is equal to spot price minus X into e power minus TRF. Yes or no? So here also same formula, but instead of writing minimum value of a call, we write value of a call. Value of a call option. Value of a call option is equal to spot price into ND1. Spot price into what? ND1. So slight difference. Spot price into what? ND1, normal distribution values, table values, minus X into e power minus TRF into ND2. Spot price is multiplied with ND1 and strike price is multiplied with what? ND2. Are you getting my point? Okay. Clear? So spot price 398.08 into 0.5498 minus X 400 into e power how many months? Minus 3 by 12 into 0.05 into 0.5060. ND1 values, ND2 values are taken from the question itself. So e power e power minus 0.0125 is also given in the question. E power minus 0.0125. Here 10 is missing. Printing mistake. E power minus 0.0125 is already given in the question. E power minus 0.0125 is equal to 0.987578. E power minus 0.0125 is equal to already given. So this 18.986 is the value of a call option as per Black-Scholes model. Understand this again. First step is what? Calculating adjusted spot price. Second step, D1 calculation. Next, D2 calculation. Later on, we have taken ND1 value, ND2 value, and then value of a call option. Value of a call option is similar to what? Minimum value of a call option formula. Spot price into ND1 minus X into e power minus TRF into ND2. So 18.986 is the answer. Second part, actually we should come from the beginning, second part. But whereas in suggested answer they have given simple answer. What would be the worth of a put option? What would be the worth of a put option if the current price is considered to be 390? What would be the worth of a put option? Worth of a put option. They are asking the worth of a put option. If the current price is considered to be 390, nothing but we should apply put call parity equation. Put call parity equation. Value of a call plus present value of X is equal to value of a put plus value of a share. That means value of a put is equal to what? Value of a put is equal to value of a call plus present value of a strike price minus value of a share. So value of a call we already know 18.986 plus present value of X. How do we get present value of X? So X into e power minus TRF. E power minus TRF value is also given. Clear? Minus value of a share. Value of a share means spot price as on today 390. In second part is given. Second part. So value of a put is equal to 24.011 390 only. So value of a put is equal to 24.011 24.011. Clear? Black-Scholes model, I mean, all information will be given in the question. You have to remember what D1 formula, D2 formula. D1 is equal to ln of S by X. ln of S by X plus R plus sigma square divided by 2 into T divided by sigma into square root of a T. D2 is equal to sigma D1 minus sigma into square root of a T. So after finding out D1 and D2, you can get ND1 and ND2 values from the question itself. But for CA final, so they will give extra data we have to find out. So that is for CA final. In CMA final, there is no chance. They will not ask. Okay. Clear? So this is Black-Scholes model. So there are 4 option valuation models: risk neutralization, binomial, 2-period binomial, Black-Scholes model. Black-Scholes model. So hedging. So we have 3 types: cross hedging, buying risk-free securities, and next what? Selling high risk shares and buying low risk shares. Buying low risk shares. And in buying risk-free securities also we have 3: fresh investment, selling shares proportionately, and buying risk-free securities. And next, selling shares in the order of risk and buying risk-free securities. Clear? So today on priority you have to practice commodity futures 2 questions. Commodity futures 2 questions. You have to practice on priority, because hedging in regular class and again in this class also, in this session also you practiced, but especially futures, commodity futures, that 2 priority CA final question. CA final question. Online students, please let me know. Anything else you want, please let me know. So derivatives, these questions are enough, and if anything else is required, I will be updating in group, or else what, I will record again, so no problem. Okay, so right now what you have to practice only these questions. Okay, so these are the set of questions I was discussing from what past 3 to 4 years, but questions are being asked from what the same. It's not easy to complete one chapter, that to a big chapter like portfolio management or derivatives, in what, one day, single day, in one go. Okay, it requires lot of patience. You have to. So for MCQs part, so we have to see option strategies. So and Greek words like Vega, Greek words Vega. I mean, in descriptive part we are not going to cover this strategies, straddle, strangle, and also what Greek words like Vega, theta, gamma. Okay, so we have covered only one Greek word, that is beta. Okay, remaining Greek words we have to cover. Okay, so tomorrow after ERP and security valuation, so while discussing bullet MCQs of security valuation and what ERP, we shall cover what derivative analysis, bullet MCQs. So while discussing MCQs, I will be covering what that strategy concept. I mean, Greek words rho, Vega, S Serenia, rho, Vega. So those concepts we can discuss tomorrow. Okay. But today on priority, what you have to practice, especially what commodity futures question. Commodity futures question. Clear? Everybody, is it clear? Vanilla? Done. So meet you tomorrow. Okay. Tomorrow we have two topics. Okay. So third day requires patience more than what second day and first day. So tomorrow we have a concepts ERP as well as what security valuation, and also we should try to cover MCQs of ERP, security valuation, and also what derivatives. Okay, without wasting time today, practice what commodity futures. Thank you all. Thank you so much.